Committee will come to order. Without objection, the chair is authorized to declare recess of the committee at any time, and all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. The hearing is entitled Legislative Proposal to Create Hope and Opportunity for Investors and Consumers and Entrepreneurs. I now recognize myself for 5 minutes to give an opening statement. It has been almost 7 years since the passage of the Dodd-Frank Act. We were told it would lift our economy, but instead we are stuck in the slowest, weakest, most tepid recovery in the history of the Republic. The economy does not work for working people. They have seen their paychecks stagnate. They have seen their savings decimated. We've seen millions who remain unemployed and underemployed in an economy working at roughly half of its potential. Dodd-Frank has been a greater burden to enterprise than all other Obama-era regulations combined. There is a better way, and it is the Financial Choice Act of 2017. The bill replaces onerous government fiat with market discipline, ends bailouts with bankruptcy, throws a deregulatory life preserver to our community financial institutions, replaces complexity with simplicity, holds both Washington and Wall Street accountable, and unleashes capital formation so the economy can move yet again for the betterment of all of our citizens. Under the Financial Choice Act, there will be economic opportunity for all and bank bailouts for none. Again, bank bailouts for none. Perhaps that's why press reports indicate that most Wall Street banks oppose the Financial Choice Act. The damage Dodd-Frank has done to consumers and business is well known to every member, but let me remind you of just a few. 75% of banks used to offer free checking before Dodd-Frank became law, but by 2016, only 38% did. Minimum balance requirements to qualify for free checking have almost quadrupled, and average monthly fees have more than tripled. This helps explain why the number of households that are unbanked and underbanked is up by more than 3 million since the passage of Dodd-Frank. Data show that there are 50 million fewer credit cards available since 2008, and the remaining options cost more now, hurting small businesses and struggling families. The Federal Reserve reports that once Dodd-Frank's qualified mortgage rule is fully phased in, an estimated 1/3 of Black and Hispanic borrowers will be denied mortgages due to its rigid debt-to-income ratio. An overwhelming majority of community banks report that Dodd-Frank's regulatory burdens are preventing them from making more residential mortgage loans, and they have had to hire more staff just to deal with the legal compliance issues. The Dodd-Frank Act represents an even more dangerous prospect, that is, namely politicized lending. Washington elites are now allocating our capital to fulfill their agendas, devoid of any checks and balances or due process. And it is impossible to bring up the threat of politicized lending without bringing up the CFPB. The Financial Choice Act reestablishes this rogue agency as a civil enforcement agency patterned after the Federal Trade Commission, one that is responsible for actually enforcing the enumerated consumer protection laws written by Congress instead of making up its own law in an unfair, deceptive, and abusive manner. True consumer protection is only to be had in competitive, transparent, and innovative markets which are vigorously policed for fraud and deception. That's what the Financial Choice Act is all about. The bill relieves financial institutions from regulations that create more burden than benefit in exchange for meeting high, yet simple capital requirements. That is loss-absorbing capital, which is like an insurance policy against failure. Instead of government bureaucrats overseeing banks that plan their failures, the Choice Act will see banks plan for their expansions by helping grow the economy for every citizen. The Financial Choice Act repeals Washington's authority to designate too-big-to-fail firms, or SIFIs as they are known, going forward, and retroactively repeals previous non-bank SIFI designations. The bill recognizes that illegal activity by bad actors at financial institutions can harm the financial well-being of consumers and society, and therefore imposes the toughest penalties in history for financial fraud, self-dealing, and deception. The bill repeals the misguided, complex, and unneeded Volcker Rule, as it has made capital markets less liquid, more fragile, and threaten financial stability. Even a Federal Reserve report now admits to this. The bill will unleash opportunities for economic growth, foster capital formation, and provide Main Street job creators with regulatory relief so more Americans can go back to work, have good careers, and give their families a better life. Ending the bureaucratic nightmare that is Dodd-Frank and replacing it with simpler capital rules of the Financial Choice Act is imperative. America has struggled for far too long. Time again to hold Washington accountable. It's time to hold Wall Street accountable. It's time for economic growth for all. It is time for bank bailouts for none. So I look forward today to our hearing and soon passing the Financial Choice Act. I now recognize the ranking member for 4 minutes.
Thank you, Mr. Chairman, and thank you to the witnesses for being here today. There's only one explanation for why we're here discussing yet another dead-on-arrival version of the Wrong Choice Act. It must be that the foreclosure crisis and the Great Recession somehow weren't enough for the majority, and so they irrationally want to clear the way for round 2. I want to be very clear for anyone who is watching. That is exactly what this bill would result in. The Wrong Choice Act thoroughly dismantles Wall Street reform, guts the Consumer Financial Protection Bureau, and takes us back to the system that allowed risky and predatory Wall Street practices and products to crash our economy. During the Great Recession, because of the actions of reckless financial institutions, Americans lost $13 trillion in household wealth. 11 million Americans lost their homes, and the unemployment rate climbed to 10%. The impact was widespread and harmful to all. The Wrong Choice Act paves the path back to that kind of economic ruin by rolling back the critical safeguards we put in place in the Dodd-Frank Wall Street Reform and Consumer Protection Act to protect American consumers, investors, and the economy. Today, we have sensible Dodd-Frank rules and Consumer Financial Protection Bureau to prevent financial institutions from peddling toxic products or abusing hardworking American consumers. Since its creation, the Consumer Bureau has returned nearly $12 billion to more than 29 million consumers who have been ripped off by financial institutions. With this financial cop on the block and with important rules of the road in place, Wall Street reform has worked. Since Dodd-Frank's passage, the economy has created 16 million jobs over 85 consecutive months, and business lending has increased 75%. Banks large and small are posting all-time record profits. Community banks are outperforming larger banks, and credit unions are expanding their membership. But here we are, and even though Wall Street reform has made them safer and they are raking in profits, that's not enough for the banks. They want to go back to the bad old days of fewer protections, and they have shamelessly undertaken a full court press to get a long wish list of giveaways, most of which have been compiled in this bill. Democrats are going to fight against it and stand up for Main Street. This bill must not become law. There's too much at stake for consumers and for our whole economy. And I will now yield to Mr. Kildee, the Vice Ranking Member.
Thank you, Madam Ranking Member, for yielding. This so-called Financial Choice Act ends the most important aspects of Wall Street reform, which were designed and passed to prevent another financial crisis. Pushing this bill puts Wall Street ahead of Main Street once again. The wrong choice for hardworking Americans. It puts Wall Street back in charge and does away with those very protections that were enacted after the financial crisis. It puts the economy back at risk. And let me be clear, I and other members on this side support improving some aspects of Dodd-Frank. But have we forgotten the lessons of the financial crisis? This takes us back to the days where Wall Street practices nearly crippled our economy, back to the days where millions of people lost their homes, lost their jobs, saw their retirement savings wiped out. The people that I represent have not forgotten these dark days, and the committee should not forget them either. Removing these important financial safeguards while at the same time eliminating the Consumer Financial Protection Bureau designed to protect consumers against those abuses, it's the wrong choice. This committee ought to reject that. With that, I yield back.
Gentlelady and gentleman yields back. The chair now yields 1 minute to the gentleman from California.
Mr. Chairman, this Choice Act takes some good bills that pass this committee with overwhelming and bipartisan majorities, puts them together with a lot more bad bills that do not have bipartisan support, and gives members no choice. You're ultimately going to have to vote up or down. Mr. Chairman, please break up this bill. You say we don't have free checking anymore. You used to pay for checking because your checking account got about 4% less interest than the passbook account. In a zero interest rate environment or even a very low interest rate environment, obviously banks got rid of free checking in many cases, and in other cases they're trying to get it on freeze. Finally, you say we don't have the economy we need. We need a better trade policy. You can't have a $500 billion trade deficit and then say we're going to make up for that by deregulating the banks and reinstituting the disasters that we suffered in 2008. The idea that we can make up for bad trade policies and restore the economy by letting Wall Street do anything they want didn't work in 2008. It's not going to work now. I yield back.
Gentlemen yields back. We will now turn to our panel of witnesses. Today we welcome the testimony first of Mr. Peter Wallison. He's the Arthur F. Burns Fellow in Financial Policy Studies at the American Enterprise Institute. He previously served as General Counsel of the U.S. Treasury Department and as White House Counsel to President Reagan. He received both his BA and JD from Harvard University. Next, Dr. Norbert Michel is a Senior Research Fellow at Heritage Foundation. He was previously a professor at Nicholls State University's College of Business, where he taught finance, economics, and statistics. Dr. Michel holds his BA from Loyola University and a doctoral degree in financial economics from the University of New Orleans. Next, the Honorable Michael Barr is a professor of law at the University of Michigan Law School, where he teaches financial regulation, international finance, and financial derivatives. He previously served as Assistant Secretary for Financial Institutions at the Treasury Department. He received both his BA and JD from Yale University. Next, Mr. Alex Pollock is the Distinguished Senior Fellow at the R Street Institute. Previously, he served as a Resident Fellow at the American Enterprise Institute and as the President and CEO of the Federal Home Loan Bank of Chicago. He received his BA from Williams College, a Master's in Philosophy from the University of Chicago, and a Master's of Public Administration from Princeton University. Next, Dr. Lisa Cook is an Associate Professor of Economics and International Relations at Michigan State University. Previously, she was a Senior Economist on the Council of Economic Advisors. As a Marshall Scholar, she received her BA from Spelman College and a second BA from Oxford University. She earned a PhD in Economics from the University of California, Berkeley. Next, Ms. Hester Peirce is a Senior Research Fellow at the Mercatus Center. She previously served as staff on the Senate Banking Committee as well as the Securities and Exchange Commission. Ms. Peirce earned her BA in Economics from Case Western Reserve University and her JD from Yale Law School. Last but not least, Mr. John Allison is the former president and chief executive officer of the Cato Institute. Prior to his time at Cato, he was the chairman, longstanding chairman, CEO of BB&T Bank. Mr. Allison graduated from the University of North Carolina, Chapel Hill, and received his master's degree in management from Duke University. Each of you will be recognized for 5 minutes to give an oral presentation of your testimony. I think perhaps with one exception, you have all testified before us, but as a slight refresher course, green means go, yellow means you have 1 minute left, and red means you had best wrap it up. Please bring the mic very close to you and press the button in order to turn it on. Without objection, each of your written statements will be made part of the record. Mr. Wallison, you are now recognized for 5 minutes for your testimony.
Thank you, Mr. Chairman, and thank you, Ranking Member Waters and members of the committee. Thanks for the opportunity to comment on the Financial Choice Act. The act would repeal or substantially modify large portions of the 2010 Dodd-Frank Act. As outlined in my prepared testimony, there are two important things to know about Dodd-Frank. It is primarily responsible for the historically slow recovery of the U.S. economy since the 2008 financial crisis, and it was completely unnecessary. Enacted hurriedly, Dodd-Frank misdiagnosed the financial crisis. Without serious investigation, the Obama administration and Congress assumed or wanted to believe that the crisis was caused by insufficient regulation of Wall Street and the financial system. In 2009, before any committee hearings, Chairman Barney Frank said that Congress would adopt a New Deal. He was correct. The Dodd-Frank Act was by far the most restrictive financial regulatory law since the 1930s. If, instead of jumping to pass new regulations, Congress had stopped to consider why we had a financial crisis, it would have found that government housing policies were the cause. In 1992, Congress enacted the Affordable Housing Goals, which required Fannie Mae and Freddie Mac to meet certain quotas when they bought mortgages from banks. First, the quota was 30%. In any year, 30% of the loans that Fannie and Freddie bought had to be made to borrowers who were at or below the median income where they lived. HUD was given authority to increase these quotas and did so aggressively through the Clinton and the Bush administrations. By 2008, the quota was 56%, meaning that more than half of all mortgages they acquired in any year had to be made to borrowers at or below the median income. The purpose of the goals was to increase mortgage credit for these borrowers, but it had the effect of forcing Fannie and Freddie to reduce their underwriting standards. Although they had traditionally accepted only prime loans, which required 10 to 20% down payments, they couldn't find enough of these loans among borrowers who met the quota. By the mid-1990s, they were accepting loans with 3% down payments, and by 2000, loans with 0 down payments. What Congress did not understand when it adopted the goals was that Fannie and Freddie, which were by far the largest buyers in the market, set the underwriting standards for everybody else. So their reduced underwriting standards spread to the wider market. Banks and others made these risky loans to compete with lenders who were also making risky loans and selling them to Fannie and Freddie. By 2008, more than half of all mortgages in the United States were subprime, and of these, 76% had been bought by government agencies, primarily Fannie and Freddie. That shows without question that the government created the demand for these loans. Risky loans, in turn, created an unprecedented 10-year housing bubble between 1997 and 2007. When the bubble deflated, housing and mortgage values fell 30 to 40% nationwide, causing losses to many financial firms and banks that held mortgages or mortgage-backed securities. Fannie and Freddie themselves became insolvent and had to be bailed out with $180 billion of taxpayer funds. Because Congress did not know what really caused the crisis, it was led to adopt a series of unnecessary restrictions in the Dodd-Frank Act, detailed in my prepared testimony. Among them are, first, costly regulations on community banks, which have prevented the growth of small business and the employment small business produces, causing 7 years of stunted economic and employment growth. Second, the creation of the FSOC, with the power to designate firms as SIFIs. Among other things, this caused GE to close down GE Capital, which had been a successful lender to small business and other growth companies. Third, an unnecessary orderly liquidation authority that will make it likely to be difficult for very large financial firms to find financing in the future. Fourth, authority for the Fed to finance failing clearinghouses, which would pave the way for another financial crisis. And fifth, the VOCA rule, which has drastically reduced liquidity in the financial markets, creating the potential for another financial crisis. The Choice Act can't be enacted too soon, Mr. Chairman. Thank you for your attention.
Thank you. Dr. Michel, you are now recognized for your testimony.
Thank you. Chairman Hensarling, Ranking Member Waters, members of the committee, thank you for the opportunity to testify today. I am a senior research fellow in financial regulations at the Heritage Foundation, but the views that I express in this testimony are my own, and they should not be construed as representing any official position of the Heritage Foundation. My testimony argues that Dodd-Frank needlessly increased borrowing cost, and that removing this excess burden will markedly increase sustainable economic growth. Dodd-Frank worsened the too-big-to-fail problem, expanded the command-control type of financial regulations that have harmed people for decades, and pointlessly addressed issues that had nothing to do with the 2008 financial crisis. My remarks will provide one example of each of these three Dodd-Frank failures. The first is the new Dodd-Frank resolution process that keeps large failing financial firms out of bankruptcy after federal regulators certify that no viable private alternatives exist. This is unequivocally the wrong approach. The very theory behind a legal bankruptcy process is that it provides for an orderly resolution of a stressed firm. It offers a financial timeout so that the company can remain a viable business while saving off a mad rush of creditors trying to get their claims settled first. Bankruptcy provides protection to debtors, which is why creditors don't like bankruptcy. So it is no surprise that over time, these protections have been whittled down. And the main problem with the bankruptcy code after 2005 was that it provided nearly all derivatives and repo agreement counterparties safe harbors from key bankruptcy protections, such as the automatic stay. These safe harbors were justified on the grounds that they would prevent counterparties from running, thus worsening a systemic crisis. But that theory has now been proven wrong. The Financial Choice Act implements an improved bankruptcy process for large financial firms by adopting the Financial Institution Bankruptcy Act of 2016, legislation that subjects derivatives and repos to an automatic 48-hour stay. The temporary stay is a welcome improvement, and the elimination of this safe harbor and all other bankruptcy safe harbors for derivatives and repos would be optimal. The second major policy mistake is that Dodd-Frank created an unaccountable federal agency based on a flawed concept of consumer protection. I'm referring, of course, to the Consumer Financial Protection Bureau and so-called abusive acts and practices. The United States did not need and does not need either. The CFPB is unaccountable to the public in any meaningful way and raises serious due process and separation of powers concerns. Most importantly, there was no shortage of consumer protection prior to the Dodd-Frank Act. Title 10 of Dodd-Frank created the CFPB by transferring enforcement authority for 22 specific federal statutes to the new agency. These federal statutes were already layered on top of state laws and local ordinances, and this framework has for decades outlawed deceptive and unfair practices, even in financial products and services. The Choice Act greatly improves the status quo by making the CFPB director removable at will, putting the agency through the regular appropriations process, eliminating the abusive behavior concept, and relegating the CFPB to an enforcement-only agency. These changes would provide an enormous benefit to U.S. citizens, but Congress can do even better by eliminating the CFPB and consolidating its enforcement authority at the Federal Trade Commission. The third major policy mistake that I'll discuss is the Durbin Amendment. Section 1075 of Dodd-Frank implemented price controls on the interchange fees charged in debit card transactions, and it did so based on the premise that banks and card networks had colluded to fix prices. If, in fact, banks and card networks are guilty of these actions, then merchants and any other aggrieved parties have a remedy in federal court. The issue is actually quite simple. Long before 2010, Congress had done its job by creating antitrust law. It should never have jumped into the middle of a legal dispute as if it were the judicial branch. Congress should repeal the Durbin Amendment and restore the rule of law, letting the courts decide if, in fact, there was collusion and price fixing. Thank you for your consideration, and I'm happy to answer any questions that you might have.
Mr. Barr, you are now recognized for 5 minutes for your testimony.
Thank you, Mr. Chairman and Ranking Member Waters, distinguished members of the committee. It's my pleasure to appear before you today. The Dodd-Frank Act was passed in response to the worst financial crisis since the Great Depression. In 2008, the United States plunged into a severe financial crisis that shuttered American businesses and cost millions of families their jobs, homes, and livelihoods. While American families have not forgotten the pain of the financial crisis, a kind of collective amnesia appears to be now descending on Washington. Many seem to have forgotten the causes of the crisis and the brutal consequences for American families. Instead of offering hope and opportunity to American families, the legislation being considered by this committee would needlessly expose taxpayers, workers, businesses, and the American economy to fresh risks of financial abuse and financial collapse. That's not a risk we can or should take. While the draft legislation has many serious flaws, I want to focus here on 3 key problems. First, weakening oversight of the financial system. Second, eliminating orderly liquidation. And third, undermining consumer and investor protection. First, weakening oversight of the financial system. The proposed legislation would weaken oversight of the financial system by eliminating the ability of the Federal Reserve to supervise systemically important non-bank financial companies, undermining the Financial Stability Oversight Council, abolishing the Office of Financial Research, and fundamentally weakening oversight of banks. The designation of systemically important non-bank financial institutions is one of the cornerstones of the Dodd-Frank Act, and a key goal of reform was to create a system of supervision that ensured that if an institution posed a sizable risk to the financial system, it would be regulated, supervised, and have capital requirements that reflected its risk, regardless of its corporate form, whether bank holding company, investment bank, insurance conglomerate, finance company, or whatever. Shadow banking gets a free pass today. The bill would also weaken Fed oversight of the biggest banks. The Fed provides for a graduated, tailored system of enhanced prudential measures that increases with stringency in the size of the firm. None of these enhanced measures apply to about the 95% of banks, the category commonly described as community banks, those with under $10 billion in assets. Exempt are more than 6,000 banks in communities all across the country. Yet to benefit huge Wall Street titans, the proposed legislation offers up a simple option to be exercised at the discretion of Wall Street firms, A 10% leverage ratio gets big firms like Goldman Sachs and Wells Fargo at heightened supervision by the Fed. That's a big mistake. It lets Wall Street choose whatever approach is the least constraining, even if it means bigger risks for the rest of us. That's choice for Wall Street, pain for American families. None of these changes will help hometown banks. Instead, small banks could benefit from safe harbor rules and plain language versions of regulations that do apply to them, as well as longer exam cycles and streamlined reporting requirements. Second, eliminating orderly liquidation. At the height of the crisis, Lehman collapsed in bankruptcy, AIG was bailed out, and President Bush and Congress stepped in to pass the Troubled Asset Relief Program. In response, Dodd-Frank authorized an orderly liquidation authority so that our economy would never again be exposed to those horrible choices. Whatever the merits of bankruptcy reform, the bill would foolishly rely solely on the hope that bankruptcy judges could manage the failure of a firm like Lehman. Orderly liquidation has three essential features not replicable in bankruptcy. First, it's part of an ongoing system of supervision. Second, the FDIC can provide liquidity. And third, the FDIC can coordinate globally to deal with the failing financial firms. Bankruptcy just can't match that. Last, undermining consumer and investor protection. Congress created the Consumer Agency to protect people from harmful and abusive financial practices. In just 6 years, the agency secured $12 billion in relief for more than 29 million consumers. Yet the bill would cripple the agency, needlessly harming American families. In sum, the proposed legislation crushes investor hope, it mocks investor opportunity, it undermines transparency, honesty, and trust essential for capital formation. Thank you very much.
Mr. Pollack, you are now recognized for 5 minutes for your testimony.
Thank you, Mr. Chairman, Ranking Member Waters, and distinguished members of the committee. Of the many provisions in the Choice Act, my discussion will focus on three key areas: accountability, capital, and congressional governance of the administrative state. Mr. Barr mentioned community banks, so we should hear from them. A good summary of the results of the Dodd-Frank Act is supplied by the independent community bankers, who say community banks need relief from suffocating regulatory mandates. The exponential growth of these mandates affects nearly every aspect of community banking. The very nature of the industry is shifting away from community investment and community building to paperwork, compliance, and examination. Now, that's certainly not what we want, but it's what we've got, because when Dodd-Frank was enacted, the urge to overreact was strong, and Dodd-Frank expanded regulatory bureaucracy in every way, in spite of the remarkably poor record of the government agencies as they helped inflate the housing bubble, a vivid lesson of the crisis, so well pointed out by Peter Wallison. And in spite of the obvious fact that the regulatory agencies have no superior knowledge of the financial future, as all of us know, because nobody does. Accountability is a central concept in every part of the government. To whom are financial regulatory agencies accountable? Who is their boss? The answer to both these questions is, of course, the Congress. All of these agencies of the government, populated by unelected employees with their own ideologies, agendas, and ambitions, and the CFPB is the best example of that, must be accountable to the elected representatives of the people who created them, can dissolve them, and have to govern them in the meantime. All must be part of separation of powers and the system of checks and balances, and this includes the Federal Reserve, as appears in the Choice Act. As the president of the New York Federal Reserve Bank testified on the 50th anniversary of the Fed, obviously the Congress, which set us up, has the authority and should review our actions at any time they want to and in any way they want to, and that seems to me entirely correct. Under the Choice Act, such reviews would happen at least quarterly. The chairman mentioned in his opening statement that people have seen their savings decimated. I'd like to suggest that for the Federal Reserve reviews with Congress, the Congress should also require the Fed to produce a savers impact statement, quantifying and discussing the effects of its monetary policies on savers and saving. Now, the most classic and most important power of the legislature is, of course, the power of the purse. The Choice Act accordingly puts all the financial regulatory agencies under the democratic discipline of congressional appropriations. This notably would end the anti-constitutional direct grab of public funds which was granted to the CFPB and which was designed precisely to evade the democratic power of the purse. I believe the Choice Act is an excellent example of Congress asserting itself at last to clarify that regulatory agencies are derivative bodies accountable to the Congress. They cannot be sovereign fiefdoms, not even the dictatorship of the CFPB, and not even the money printing activities of the Federal Reserve. Turning to banking, the best known provision of the Choice Act is to allow banks the very sensible choice of having substantial equity capital, to be specific, 10% or more tangible leverage capital ratio, in exchange for the reduction in onerous and intrusive regulation, because such regulation becomes less and less justifiable and less sensible as capital rises. And more capital for less intrusive regulation is a rational and fundamental trade-off. It seems to me the 10% leverage capital ratio, conservatively calculated as proposed in the Choice Act, is a fair and workable level. As a final comment, the Choice Act makes positive changes to the FSOC, but FSOC or anybody's forecasts of the unknown financial future are hard to get right and unreliable. So higher capital is a better protection than another 10,000 pages of regulations. I hope the committee will promptly advance the Choice Act, and thank you for the chance to be here.
Dr. Cook, you are now recognized for your testimony.
Okay. Chairman Henserling, Ranking Member Waters, and members of the committee, thank you for the opportunity to testify today about the Financial Choice Act of 2017. In the winter of 2008, when I was teaching macroeconomics at Michigan State University, I looked out my window one evening and saw a line of students snaking around the corner and down the street from the building across the way. It was not a typical line of boisterous students waiting to purchase something like football tickets. The mood was somber, and no one was talking. I approached a colleague to ask what was happening. He said it was a line for the food bank. Students who lost their jobs and funding were going hungry. No wonder the scene was so jarring. It was straight out of Dorothea Lange's iconic photos of the Great Depression. Many of these students had to drop out of MSU to support their families. And this was happening in my lifetime, on my campus, to my students and their families. It was also happening to many students and families across the country. Recall that the recession began in December 2007. This was the time when the auto industry was bleeding jobs. It lost 31% of its workforce between 2008 and 2009. In Michigan, the number of foreclosures nearly doubled between 2008 and 2009, and that was after having quadrupled between 2005 and 2008. With 1 in 7 jobs tied to the auto industry, the country was more broadly losing more than 700,000 jobs per month. Ultimately, the economy would shrink by 8.9% that quarter, the last quarter of 2008. Anyone witnessing this would have said, never again to the job losses, never again to the disruption in families and communities, and never again to the irresponsible lending and financial practices accompanying these undesirable outcomes. Among those irresponsible financial practices was that banks were placing bets with public money. If they won, banks' profits would soar, and bank managers and owners would be paid. If they lost, American taxpayers would pay through deposit insurance or direct government bailouts. The banking system, the banking business model, and their impact on people and the economy all required reexamination. The Dodd-Frank Wall Street Reform and Consumer Protection Act was one legislative response intended to reassure taxpayers and to signal to regulators and financial institutions that this would never happen again. Is a law constraining lending and therefore economic growth? My calculations suggest that this is not the case. If higher capital requirements constrain lending and therefore economic growth, we should see a fall in both since the passage of Dodd-Frank in 2010. Instead, we see both increasing. According to the latest data available, commercial and consumer loans grew between 0.5% and 12% annually since 2012. Household debt at the end of 2016 stood at $12.6 trillion, which is only 0.8% shy of its $12.6 trillion peak in the third quarter of 2008. The economy has expanded 0.2% and 6.7% each quarter since the first quarter of 2011. Does the Federal Reserve require more oversight? No. The kinds of provisions being proposed in the Financial Choice Act resemble financial reforms implemented in many of the emerging markets and developing countries I have advised or researched to disastrous effect and would undermine the credibility of the Federal Reserve. This would be okay if we were a small island nation with no financial transactions and no interaction with the outside world. But we're the largest economy with extensive financial ties to the rest of the world, and this would not be appropriate for us. In conclusion, this body should say never again to the wild, bleak days of unfettered consumer and bank finance. It should say never again to the losses in houses, firms, communities, hope, and opportunity that the recent financial and economic crisis brought. It should declare never again by engaging in thoughtful financial reform and rejecting many provisions of the Financial Choice Act.
Ms. Hirsch, you are now recognized for your testimony.
Chairman Hensarling, Ranking Member Waters, and members of the committee, thank you for the opportunity to be part of today's hearing. As Dr. Cook's poignant description of the financial crisis illustrates, what the financial system does and how it's regulated really matters for the rest of the economy. And so it makes sense periodically to look at the financial system and look at how it's regulated and take another look to see whether it's working as it should. I think that improvements can be made, and the Choice Act offers a number of improvements that will make the financial system work better for the rest of the economy. I'll talk about some of the improvements today. First of all, good rules require good process. Without good process and without accountability, you don't get good rules. The Choice Act makes a number of improvements to make sure that rules that are imposed on our economy are done through notice and comment rulemaking. It also takes an important step of requiring that the financial regulators conduct economic analysis. This exercise is designed to ask, what problem are we trying to solve? To look at different potential solutions to solve those problems, and then to look at the costs and benefits associated with each of those potential solutions. And then to build into a rulemaking metrics so that you can go back 5 years later and say, is this working as we intended it to work? Is it achieving the goals that we intended it to achieve? And the Financial Choice Act also builds on the economic analysis requirement by then requiring that Congress take a look at rules when they're final and say, and consider again whether they want those rules to go into effect. The value of doing this, especially with an economic analysis in hand that might alert Congress to unintended consequences, is huge. This gives an important measure of accountability. Another important measure of accountability is the new requirement that financial regulators be appropriated as other agencies are. It's very important to have this level of accountability. Another important piece of the Financial Choice Act is the attempt to shut off avenues for bailouts. One such example is the elimination of Title VIII of Dodd-Frank. Title VIII was the companion to Title VII, which deals with the derivatives, with over-the-counter derivatives. Title VII moved a lot of over-the-counter derivatives into central clearinghouses. And as the drafters of Dodd-Frank realized, doing this might just create the next too-big-to-fail entity. And so the solution to that concern was to create the Federal Reserve as backstop for these clearinghouses. That creates terrible incentives. So eliminating the backstop will force regulators and market participants to concentrate on risk management and to also think about the important questions of recovery and resolution. What happens when there is a problem at a clearinghouse? There are some discussions of this issue already, but taking away Title VIII would focus the mind on these discussions further. And then another important part of financial regulation, which the Choice Act recognizes, is the need to allow the capital markets to work. We need to allow investors and companies to meet in the capital markets in ways that are mutually beneficial. And the Choice Act opens up new avenues for investors and companies to come together. It also takes the important, it also addresses another important problem, which is that many companies don't go public anymore, which means that investors can't participate in the growth unless they're accredited. The Choice Act makes a change in this by allowing more investors to qualify as accredited, but it also looks at the problem of why companies aren't going public, and it seeks to reduce some of the burdens associated with being public. These burdens are not associated with a benefit to investors, and so the Choice Act pulls them back. The bottom line is that regulatory reform needs to work for consumers, investors, and Main Street companies. That's the objective of financial regulatory reform, and I believe the Choice Act has many elements that further these objectives. Thank you very much.
Mr. Allison, you are now recognized for your testimony.
Thank you, and good morning. Appreciate being asked to testify. At the time of the most recent financial crisis, I was the longest-serving CEO of a major financial institution in the U.S., BB&T. My company went through the financial crisis without a single quarterly loss. I have the unique experience of being in a key decision-making position in a bank during the last three financial crises, the early 80s, early 90s, and the most recent crisis. Unfortunately, in my view, government policy unquestionably was the cause of the financial crisis. Two primary components of the government action created the crisis. First was housing policy, which Peter Wallison described well. Second were errors by the Federal Reserve, two categories, one monetary policy and second regulatory policy. In terms of monetary policy, in the early 2000s, we were having a minor correction that we needed. The Federal Reserve created negative real interest rates that you could borrow less than inflation, was a huge incentive for people to borrow. It created bubbles in housing, but people fail to discuss it created bubbles in the commodities market, in the stock market, and in car finance that led to the failure of the car industry. You can't have all those bubbles without the Federal Reserve making mistakes on monetary policy. On regulatory policy, the Fed incented risk-taking. You could have half as much capital for a loan to a subprime lender as you could to Exxon. Nothing can incent risk-taking more than that. In addition, the Federal Reserve and other regulatory agencies did a terrible job handling this crisis in comparison to the other two. They made two meta mistakes. First, they created a huge amount of ambiguity. In the past, we had strategies. This was totally arbitrary. They saved Bear Stearns, failed Lehman Brothers. They failed Wachovia, they saved Citigroup. When Washington Mutual fails, they cover the uninsured depositors and they take it out of the height of the bondholders instead of out of the FDIC insurance company. Markets can't deal with ambiguity. Secondly, and this is huge and under-discussed, how they handled the credit issue was big during this crisis. In the past, what they did was cause small banks that were in trouble or big banks that were in trouble to fail. They let the bad banks fail, but they let healthy banks like BB&T keep doing their lending. This time, they saved the unhealthy banks and forced the healthy banks to stop making loans. It was bizarre what happened. BB&T was forced to put thousands of borrowers out of business that we would not have put out of business that would be creating jobs today. Unfortunately, tragically, they continued with that pattern. It's particularly been destructive in what I call venture capital small business lending, where they're obsessed with mathematical modeling. In venture capital small business lending, a lender makes a judgment of the individual and the character, not just the numbers. That's what I started out in the banking business, and fortunately, I helped a number of companies get started that have created hundreds of thousands of jobs. We can't make those kind of loans. Now, that doesn't start out as a big loan because it doesn't get to a big loan till the company gets big. So these loan growth numbers are very distorted because what's happening, you can study the numbers, there's been a massive increase in assets going to large companies and the government at the expense of small companies and lower income and moderate income consumers. Dodd-Frank is caused consolidation in the industry. There have been practically no startups. It's destroyed innovation. It's led to less competition. It's hurt small business, low income and average consumers, and slowed economic growth. For those of you that are concerned about safety and soundness, why would you believe the regulators know how much risk we ought to take? They just caused this last crisis. In my career, they always overreact. They encourage too much risk in good times, too little risk in bad times, which is what they're doing today. They don't have any magic wand. Markets do a much better job of that. I think it's ironic that they've actually increased systems risk by trying to reduce an individual institution. Some banks should be failing. Businesses are failing all the time. They force everybody to take the same risk, which increase risk. Capital is a far better protector of risk. Highly capitalized banks very seldom fail, but primarily because it puts some real skin in the game. You know, I had a lot of BB&T stock. I cared how BB&T did. When people put capital in the game, they care. And if you allow institutions like Citigroup basically had no capital when they were effectively failed, people are going to take a lot of risk. I think it's ironic that the institution that caused the biggest trouble, the Federal Reserve, has got more power out of this crisis. And I also think it's ironic that a lot of people that are concerned about consumers are on the same side of Wall Street banks. Listen, the Wall Street banks love Dodd-Frank because they've achieved regulatory capture. In my career, they always captured the regulators, and that's exactly what they've done in this case. Thank you for listening.
Thank you, Mr. Allison, and thank you all members of the panel. The chair now yields himself 5 minutes for questions. Who seeks recognition? For what purpose does the gentleman from Missouri seek recognition?
Parliamentary.
Gentleman will state his inquiry.
Mr. Chairman, because a lot of people are coming in and out trying to go to other committee hearings, well, first of all, let me thank you for having the hearing. We've had the other major piece of legislation that's gone through, didn't go through regular order. So I appreciate this, but this is a huge piece of legislation, and I'm just hoping that we can have more than this one hearing.
If the gentleman would state his point of order.
The point of order is
Parliamentary inquiry.
Yes, I'm sorry. I thought I'm sorry. It's parliamentary inquiry. And my inquiry is, will there be additional hearings due to the significant nature of this legislation and how huge the bill is? We had I can't remember, 40-something, I think, hearings on Dodd-Frank, and 41. And I would hope that we could have, we probably don't need 41, but I hope we can have more than just this hearing.
Well, I'm not sure the gentleman has stated a proper parliamentary inquiry. Nonetheless, by the chairman's count, over the last 3 Congresses, we have now had 145 different hearings on the Dodd-Frank Act and aspects of the Choice Act. Having been here during Dodd-Frank, I don't remember a single hearing on the combined Dodd-Frank Act, but I assure the gentleman from Missouri we expect to have even further hearings in this Congress to monitor all aspects of banking, financial capital, the Dodd-Frank Act, and the Choice Act.
So yielding
for what purpose does the ranking member seek recognition?
To seek a clarification of whether the gentleman asked about Dodd-Frank or Choice Act. Are you saying you've had 145 hearings on Choice? Are you combining the two? What are you referring to?
Well, again, the gentlelady doesn't pose a parliamentary inquiry. So if the gentlelady wishes to propose a parliamentary inquiry, the chair will entertain it.
Well, thank you very much, Mr. Chairman. I shall continue with the gentleman's question about whether or not there will be additional hearings based on the complexity of the Wrong Choice Act.
Okay, well, again, by our counts, we have had 145th hearing on the problems of the Dodd-Frank Act, and I plan to have dozens more hearings on the negative impact of Dodd-Frank on the American people and the economy, and the minority will certainly be noticed on these hearings. Chair now yields himself 5 minutes for questions. Mr. Wallison, since the passage of the Dodd-Frank Act, the big banks have become bigger and the small banks have become fewer, as I think you well know. Something I'm particularly concerned about is a Federal Reserve report by the name of the Bailout Barometer that indicates since the financial crisis and the passage of Dodd-Frank, we now have a whopping 62% of total liabilities of the financial system are now backstopped by the federal taxpayer, either implicitly or explicitly. If I recall right, that's up about 1/3 since the crisis. I'm thinking specifically of Titles I and Title II, the OLA and SIFI designation process of Dodd-Frank. Has the designation of too big fell to firms made the economy more stable or less stable in your opinion?
In my view, it's made the economy less stable. There are so many reasons why a firm that is declared to be a SIFI is going to cause difficulties for our economy, one of which, of course, is that it gives the impression that the government has declared this firm to be too big to fail, which means that the firm will then be treated by the market as though lending to that firm is without possible consequences, just like Fannie Mae and Freddie Mac, which were, many of us said for many years, treated as backed by the government, even though formally they were not. So the result of that is that these firms that are looked at as too big to fail will be able to get credit for their activities without having to take the kinds of steps that the market would normally require them to take under market discipline to reduce their risks. So simply designating firms as SIFIs does increase the potential risk in the economy and in the financial system, and that's one of the reasons why I oppose the designation process. There are several others, but that's one.
Dr. Michelle, under, I guess it's Title II of Dodd-Frank, the Orderly Liquidation Authority gives the FDIC new broad sweeping discretionary powers in bailing out financial institutions. It is my understanding that under Dodd-Frank, we could look at another AIG-like bailout where foreign banks could receive 100 cents on the dollar. Is that your understanding, and did you have concern on this regarding the Orderly Liquidation Authority?
That is my understanding. That is a big concern. I think from a broader perspective, if you want to end bailouts, you don't formalize a process where the government can say there's no other private alternative, so the FDIC is going to handle this. And somehow that's supposedly not a government bailout or not government funding. It just doesn't make any sense if you want to end that process. So I have major concerns with that.
So, Mr. Allison, you have the most banking experience on this panel. You mentioned earlier, you were speaking of the role that capital really played in financial stability. Basel III sets up a risk-weighted asset regime versus the simple leverage ratio of the Choice Act. In your decades of experience as a banker living through 3 different financial panics, can you kind of contrast and compare the 2 different models? And I believe I've seen FDIC data that indicates that 98% of all banks that had at least a 10% simple leverage ratio survived the second worst financial crisis in America's history, which I suppose would suggest some level of financial stability. But could you expound on your views here, please?
Yes, sir. I think Basel can be gamed. Before the financial crisis, these banks were doing all the risk modeling, the banks that got in trouble, and they gamed the system. And you can easily game the system by how you use the mathematics and what probabilities you put on certain kinds of losses. Second, it's self-defeating because it puts less capital on certain kind of assets, which means banks are going to get more of those assets and drive the risk up in the assets. And the classic example is subprime lending. It had half as much capital, so you got a lot of subprime lending. In Europe, Greece had no capital required, so Greece got a lot of money. So when you try to risk weight the assets, you defeat the outcome, because up to a few months ago, energy lending had less capital, and now it has more capital after the fact. They always figured it out after the fact.
My time has expired. The chair now yields to the ranking member for 5 minutes.
Thank you very much, Mr. Chairman. Mr. Pollack, in his statement, said that the community banks and states need relief from suffocating regulatory mandates. And I'm concerned about whether or not Mr. Pollack and others who talk about community banks are as concerned about community banks as they are of the too big to fail banks. Mr. Barr, let me ask you, the Wrong Choice Act 2.0 would eliminate restrictions on mergers, acquisitions, and consolidations of banking organizations that choose the off-ramp to regulation as long as the banking organization maintains a quarterly leverage ratio of at least 10%. Would this provision, in addition to the other deregulatory efforts under the Wrong Choice Act 2.0, potentially allow the largest banks to grow exponentially larger and even more interconnected, which would leave the banking system open to greater vulnerabilities that would trigger another financial crisis?
Yes, I believe that provision will further increase concentration at the very top of the financial sector, will permit the very largest firms to grow significantly bigger. It may stifle competition both in the mid-sized market and the smaller market, and I believe it will increase systemic risk.
So this is not about protecting community banks. This is about allowing the biggest banks in this country to have that kind of off-ramp. Ms. Cook, the Wrong Choice Act 2.0 would provide a so-called off-ramp for banks of all sizes, including the trillion-dollar banks on Wall Street, to opt out of all enhanced prudential standards under Dodd-Frank for stronger capital, liquidity, and risk management, as well as Basel III capital and liquidity requirements if they meet a 10% leverage ratio requirement. Because regulators recently noticed that they are working Regulators have already said that they're working on simplifying capital requirements for community banks. Is it appropriate to roll back these important rules for Wall Street at this time? What are we doing here?
I didn't quite hear the end of your question, but I think I got the gist of it. Certainly, giving the supervisors and the regulatory authorities less power, having them collect less data, I think would be detrimental to our financial system, not just in the United States, but to avert the next global financial crisis. Again, I was saying that the provisions of the Choice Act would be appropriate if we were a small island nation that didn't interact financially with other nations. But for the largest financial system, for the largest economy in the world, this would be inappropriate.
Mr. Barr, getting back again on this discussion about community banks, we hear a lot about wanting to protect community banks, wanting to get rid of the regulations that are causing them so much pain, but we find they're doing quite well. They are, the profits are up, et cetera, et cetera, et cetera. Would it be reasonable to conclude that this is really about the big banks in America and providing them the opportunity to not have the oversight and regulation that we have put together in Dodd-Frank reform that would avoid another recession, almost depression that we went through?
Yes, I completely agree with that. I think if the issue were a focus on community banks, we would be debating in front of us a bill on community banking. But that's not the bill we're debating. We're debating a bill that takes on really all the post-financial crisis reforms that weakens oversight of the biggest banks, it weakens oversight of the shadow banking system, it makes it much more difficult for consumers to get their day in court, it blocks consumer protection that helps families across the country. So this is not a community banking bill that we're discussing today.
And does this open up the door for more acquisitions and reduces the big banking community to, instead of 5 or 6 banks, maybe 3 in this country?
I wouldn't want to, guess about the exact structure, but it certainly eases restrictions at the very largest firms to engage in merger and acquisition activity, irrespective of concerns about financial stability. And the other measures that are undertaken in the bill suggest significantly less oversight of those firms with respect to stress testing and the process for resolution planning. So I do think that the very largest firms are going to benefit a great deal under this legislation.
You were around when we went through the meltdown in 2008, and you know how scary it was. And we did not know what to do. We ended up with this bailout. Should we go through that again? Do we have to go through that again?
Mr. Chairman, I see I'm out of time. May I respond?
Quickly.
I don't think we can afford to go through that kind of crisis again, and the Orderly Liquidation Authority and the prudential measures put in place were designed to prevent the kind of problems of bailouts in the future. I think it would be a mistake to repeal them.
Thank you very much. I yield back.
Gentlelady yields back. The chair now recognizes the gentleman from New Mexico, Mr. Pierce, chairman of our Terrorism and Illicit Finance Committee, for 5 minutes.
Thank you, Mr. Chairman. Thanks to each one of you for your presentations today. Mr. Allison, you appeared to be, yep, here.
Okay, right.
You appeared to be in the eye of the hurricane while the hurricane was going on. So I'm going to refer a question. There are 2 different narratives that always pop up when we're in these kinds of hearings. One is well stated by Mr. Wallison, where he describes in his text that the enactment in 1992 of the affordable housing goals then the underwriting of Fannie and Freddie was compelled to take those on. If that underwriting had not have been available, then the implication is that banks would have stayed in the lane, but since they could get rid of the loans, then the system just got out of control. The other narrative is that the big banks were somehow evil and then without any support at all, just went out and did these things on their own. So you were in the eye of the hurricane. Can you give a perspective on how this actually developed? A brief perspective, please.
Yes, sir. It's no question that government policy caused it. Freddie and Fannie were the giant providers of credit in the marketplace. They dominated the market because they had government implicit guarantee, so they had the lowest cost of capital. BB&T had been what they call a portfolio home mortgage lender requiring 20% down. We were driven out of that business. That's where most other banks. And then the regulators wanted banks. They wanted Wall Street to do subprime lending. A lot of people that blame the banks were the people that actually forced banks to do subprime lending because we didn't want to do that, most of us, because we were lending other people's monies, and banks really shouldn't be doing that.
And then the big banks, seeing the opening, said in order to get more of these loans in this area, we will give bonuses. But if the banks could not have gotten rid of those loans, then how many of the big banks would have had incentives for things where they're going to eat the loan if they couldn't resell them to a government-backed enterprise?
They wouldn't have.
Yeah.
They wouldn't.
Okay. Thank you. Appreciate it. Mr. Wallison, you say that Fannie and Freddie you hint that they were compelled. Were they actually compelled through legislation or pressure or how? That Fannie and Freddie changed their underwriting standards. How did that compulsion look and feel? Was it legislation?
The affordable housing goals was legislation. The Department of Housing and Urban Development was given authority to raise the goals. The original goals were 30% of all mortgages they bought in any year had to be made to people who are at or below median income where they lived. HUD raised those goals to 56%. Now, you can say Fannie and Freddie could have ignored that, but they couldn't. These regulations from HUD were binding on Fannie Mae and Freddie Mac, so they had to find those mortgages.
Okay. So
you can't find prime mortgages if more than half of all mortgages you're allowed to buy are made to people who are below median income.
Okay, so of the two narratives that evil institutions caused it and greed caused it versus the government regulators and congressional law, that's clear. Now, we also hear, Mr. Allison, that the community banks have exceptions. They're exceptions to the rule. Mr. Barr said that in his testimony. Why don't those exceptions work out? Because my bankers, the community bankers in rural New Mexico with 4,000 and 5,000 people in a town, are livid about Dodd-Frank and livid about the CFPB. Why aren't those exceptions in place? I mean, I know they're written into the law, but so how does that work out?
Well, community bankers are adamantly opposed to Dodd-Frank, and I know hundreds of them. And the reason is, it's nice to say the regulators can make an exception, but if you're a regulator and you make an exception and your bank gets in trouble, then you get blamed. So in fact, most of the Dodd-Frank provisions are hurting community banks. And you can raise the level and all that, but they're not going to really be exempt because the regulators are just human beings. They don't want to get in trouble if their bank gets in trouble, so they're going to apply basically the same rules to community banks they provide to big banks.
One of the testimonies, I forget which one, talked about having firefighters put out fires. And it made me think about the forest in Mexico. The Forest Service regulating the forest began to quit cutting trees. They stopped cutting trees about 60 years ago or whenever. And so typically trees in New Mexico are about 50 trees per acre. Now we've got 5,000 stems per acre. And the fires break out and they're catastrophic fires. And so the Forest Service now says we need more firefighting money. What we needed is to stop letting the trees grow to start with. And so it looks like a very close parallel to what should have been done here. I yield back, Mr. Chairman. Thank you.
Time of the gentleman has expired. The chair now recognizes the gentlelady from New York, Ms. Maloney, ranking member of our Capital Markets Subcommittee.
Thank you. I think it's important that we remember why we passed Dodd-Frank in the first place. We did it because our country experienced the worst financial crisis since the Great Depression. 8 million people lost their jobs. 6 million people lost their homes. The crisis destroyed over $5 trillion in wealth for the middle class, their savings, their pensions. It just evaporated. And overall, over $13 trillion in household wealth in this country was lost. But with better regulation and with the tools that we put in place in Dodd-Frank, we can prevent this type of devastating financial crisis from happening again. So it's important not to go backwards, which the Wrong Choice Act does. So my first question is to Professor Barr. One of the main ways this bill, in my opinion, goes backwards is by repealing Dodd-Frank's orderly liquidation authority. I find this provision deeply, deeply, deeply troubling. The creation of the resolution authority for large non-bank financial companies like AIG and Lehman was one of the most bipartisan ideas in Dodd-Frank. In fact, it was originally proposed by the Republican-appointed Treasury Secretary Hank Paulson, and it was supported by the Republican-appointed Fed Chair Ben Bernanke and the Republican-appointed FDIC Chair Sheila Blair. And it's important to remember that the FDIC has long had the authority to resolve commercial banks outside of the bankruptcy process. And all Dodd-Frank did was give the FDIC the authority to do the same thing for large non-bank financial institutions. This was very important because when many of the big non-bank financial institutions were on the verge of collapse, we had only two choices. One was the chaotic, disorderly bankruptcy, like Lehman, which went under, or a bailout, like AIG. Neither was a good choice. Dodd-Frank gave the regulators a third option, an orderly wind down that prevents a government bailout but does not harm the overall broader markets. But now the majority has somehow convinced themselves that this long-standing FDIC authority is some type of evil new taxpayer bailout. In their minds, allowing the FDIC to take away a failing financial firm, fire the management, wipe out the firm's shareholders, impose losses on the firm's creditors, and completely liquidate the firm, that, in the majority's mind, somehow constitutes a bailout. So my question is, I'd like to ask you, Professor Barr, is the orderly liquidation authority in any way, shape, or form a bailout?
No, it is not. The orderly liquidation authority actually is the opposite. It provides a realistic chance of winding down a firm or a set of firms in a financial crisis to avoid the kind of bailouts and also chaos we had in the fall of 2008. And so if you look overall at the legislation we're considering now, the Financial Choice Act, in my judgment, would move towards bailouts, move us away from the system of orderly liquidation that was put in place in Dodd-Frank. I think that's quite dangerous both for taxpayers and for the financial system.
So I agree. So I want to ask you again, what would happen if the majority is successful in erasing the orderly liquidation authority?
Well, I think that it would make it more likely that in the next financial crisis, Congress and the President would be faced with the same horrible choices they faced in 2008, and I think it will mean that we'll see more bailouts and more chaos in financial markets. So it'll be the worst of both worlds. We're going to get more taxpayer bailouts and more harm to the economy, and that's why I think it would be a serious mistake to repeal orderly liquidation.
And the living wills. If the orderly liquidation authority is repealed, making a traditional bankruptcy the only option for a failing financial institution like AIG and Lehman, would make living wills more important. Would it make them more important or less important?
I think it would make it even more important to have a very robust resolution planning process with living wills, with simplification of holding company structures, and with the other sets of supervision undertaken.
So why in the world would the majority want to make bankruptcy the only option?
Brief answer.
I believe that it would be a serious mistake to rely only on the bankruptcy courts. I think it should be an option, but not the sole option for dealing with a failing firm.
Time of the gentlelady has expired. The chair now recognizes the gentleman from Missouri, Mr. Lukemeyer, chairman of our Financial Institutions Subcommittee.
Thank you, Mr. Chairman. Just take a moment. I do have a request for unanimous consent to enter into the record a statement from the Electronic Payments Coalition.
Without objection.
As well as the Independent Community Bankers of America have a statement as well.
Without objection.
And it's kind of interesting, the community bankers, they represent 6,000 community banks, support the Choice Act. which if Senator or if Professor Barr is really interested in the big banks going through and supporting something, they do not support the Choice Act. I haven't spoke to a single one yet that supports this. Yet, and you wonder why, whenever they don't want to give up their implicit guarantee from the federal government. So I don't know where that statement came from, but it defies the facts. With that, Mr. Allison, you have testified with regards to the capital ratio here a couple times already this morning, and I want to just follow up with regards to something that Mr. Barr said. Again, he said he offers up that the Choice Act offers a simple option to be exercised at the discretion of Wall Street firms, a 10% leverage ratio that gets big firms like Goldman Sachs and Wells Fargo out of the heightened supervision of the Fed. If you actually look at what happens if they get to that point, you're looking at $430 billion that's added to the capital structure of these big banks. Number one, do you think that's a giveaway to Wall Street?
I do not.
Do you think that this improved capital leverage ratio would be detrimental to financial stability and economic growth?
I think it would substantially reduce financial risk, far more than more regulations, and I think it would be good for growth because banks would be more rational in allocating capital to the most productive ends because they would be lending more of their own money.
Thank you. Mr. Pollack, you also mentioned some things with regards to this. It would seem to me that it would, anytime you put the private sector dollars on or at risk versus the taxpayers' dollars at risk, that would seem to me to be a preferential situation, which the capital leverage ratio, this 10% ratio, actually does. Because suddenly, if the owners of the institution have their own money at risk, they're going to be a little bit more, I would think, discretionary about how they run that institution versus if they know that the taxpayers are going to bail them out, regardless of what decision they make, it would, I would think, enhance risky behavior. Can you comment on that?
Congressman, I completely agree, and I talked about that as accountability, putting up more capital. There's also the issue of, as Mr. Allison said, of skin in the game in your own business, of being actually at risk in the business you do, and there are provisions in the Act which give relief to the small lenders who actually operate on a skin-in-the-game basis in their mortgage lending, which I think are a very good idea.
Well, I know that Mr. Allison also made a comment with regards to the community banks and regulations, and I know in your testimony you also made that comment that it would be very beneficial to help them be able to survive. I assume that's...
I think without question, intrusive and extensive regulation falls disproportionately heavily on smaller organizations. That's true every place, but it's also true in banking. And the bigger banks can create bureaucracies to face off against the government bureaucracies. The smaller banks are strangled by that same bureaucracy, and that's in their own words, as you point out, Congressman.
Mr. Michel, one of the things that Dodd-Frank did was give the authority of the unfair, deceptive, and abusive acts and practices situation to authority, anyway, to the CFPB. The key word there is abusive. Has anybody ever defined what abusive is? Has the CFPB ever defined what abusive is?
No, and Director Cordray actually said that it would be a bad idea for them to define abusive practices, and said that we should just look at these things on a case-by-case basis. So we know that they're not unfair, we know that they're not undeceptive, but there's something else, and we'll figure that out as it happens.
Wow, that's like putting police in charge and saying, well, they can decide what's a crime, what's not a crime. Is that basically a good analogy?
Yeah, that's hardly the rule of law, yeah.
Well, I know we have a bill to do just that very same thing, and in this Choice Act is something to make sure to do that as well. Mr. Wilson, before I get away here, you make a couple of comments with regards to the slow economy and part of it being done as a result of Dodd-Frank. Former Fed Chair Alan Greenspan last week made the comment that if we did away with Dodd-Frank, it would spur the economy. Would you like to get a quick 10-second comment on that?
I didn't hear his comment, but I would say that the problem is that Dodd-Frank has caused such a decline in the number of small banks that it's very hard for small businesses that rely on small banks to get the kind of financing that would keep our economy going.
Okay, thank you. I yield back.
Time of the gentleman has expired. The chair now recognizes the gentleman from California, Mr. Sherman.
Mr. Chairman, I should reiterate my plea that we vote on these bills separately so that members of this committee have a choice. There are 12 bills that the Choice Act has swallowed up that have the support of half or more of the Democrats and half or more of the Republicans of this committee, and we ought to be moving those bills separately. Of particular importance is the Preserving Access to Manufactured Housing Act, and the Mortgage Choice Act. These bills will pass this committee overwhelmingly if we bring them up separately. We're told that it is government's fault, overregulation, but you cannot say that overregulation caused the panic of 1814, the panic of 1819, the panic of 1837, the panic of 1839, the panic of 1857, the panic of 1861, the panic of 1873, the one of 1893, or October 1907. And overregulation did not cause the Great Depression, nor did it cause the 2008 Great Recession. We're told that it's Fannie and Freddie were making loans that the private sector, at least those not subject to HUD regulations, would never make. But it was the credit rating agencies that gave AA and AAA ratings to Alt-A loans that Freddie and Fannie wouldn't touch, and to loans that did not meet Fannie and Freddie standards. And, Mr. Chairman, your bill eliminates the last vestiges of already unenforced Frank and Sherman to regulate the credit rating agencies. As long as they give a high rating to bad bonds, whether they're mortgage or otherwise, portfolio managers almost have to buy them. How does a portfolio manager say, well, the guy across the street's getting a 7% return on AA-rated bonds, but I prefer a 6% return because I don't trust the credit rating agencies? How am I supposed to invest in Vanguard if T. Rowe Price is giving me 0.5% more and their bond portfolio is AA-rated just as the Vanguard one is? The problem we have, the problem that this committee has not fixed, is that the credit rating agency is the only game where the umpire is elected and paid by one of the teams, namely the issuer of the bonds. As long as that happens, you can blame Fannie and Freddie for bonds they never touched, that got AA rated, that portfolio managers on pain of being fired had to buy to match other portfolio managers, and we didn't do anything about it. Mr. Barr, this discussion of a 10% capital rate, meaning basically no regulation. Do you think it makes sense to allow a business model in which you get a lot of capital or money through FDIC insured deposits, and you're free, as long as you have 10% capital, to buy Zimbabwe bonds, high-risk bonds, super high-yield bonds? Would we be opening things up to a business model of 10% capital and extreme high-risk debt instruments?
I do think it's a mistake to rely on only one form of capital rule. There's not any perfect capital rule. The 10% leverage requirement has a positive attribute for firms where it raises their equity position, but it has lots of downsides as a sole tool. And one of those downsides is that without a measure of the riskiness of assets, you're incentivizing the firm both to move items off the balance sheet and also to engage in riskier lending activity. I think both of those are a problem. And it would also remove the full set of heightened supervision that is enhancing the safety of the firms.
I thank you, and I want to focus on this issue of bailouts. I opposed the first 5 drafts of Dodd-Frank because they provided permanent unlimited bailout authority. We got rid of those provisions. We do have orderly workout authority. But, Mr. Chairman, we will have another bailout if we have another 2008. As long as there's an institution big enough to call the White House and say, we're going down and we're taking the whole economy with us. You know, you were there, you opposed it, I opposed it, but this Congress will pass a bailout bill under those circumstances. The way to deal with this is the Sanders-Sherman approach. Break up every institution that is over 2% of GDP. Otherwise, it's just Band-Aids trying to pretend we won't have a bailout. We allow too big to fail to exist.
Time of the gentleman has expired. The chair now recognizes the gentleman from Michigan, Mr. Huizinga, chairman of our Capital Markets Subcommittee.
Thank you, Mr. Chairman, and I'd like to start by offering to enter into the record a letter of support from Duff & Phelps, one of the leading firms in mergers and acquisitions and valuations, specifically on Section 822.
Without objection, covered under general leave.
Thank you. I want to get to Ms. Peirce here on a couple of things. I was intrigued as you were talking about sort of the Title VII, Title VIII, but we may need to revisit that at another time. What I liked is you used a phrase, I think, where we need to have people meet in the marketplace is, I think, the phrase that you used or something like that. And what we have seen is, I believe, less access to the financial opportunities that are out there that have occurred. And on March 22, we held a Capital Markets Subcommittee held a hearing where we had a witness testify that 2016 was one of the slowest IPO years since 2008. And I'm curious if you could comment on that.
Sure. I think it's a big problem that companies, it's understandable that companies are waiting longer to go public. It's very expensive to be public. And so many are choosing not to. And when you become public, you subject yourself to litigation risk, and many worry about that. I think efforts that will lower the cost of being a public company while still ensuring that investors are protected are very important. There are a number of these included in the bill.
Wait a minute. Do you think we can do both?
I think it's possible to do both. And
because if you listen to the rhetoric from the other side, it's one or the other.
And I think that's what's led us to the place we're in, which is we think of protecting investors in a very specific way, which is just making sure that investors never get harmed, but we never think about the opportunities that we shut them out from participating in. So as a company is growing, we want to let investors be part of that growth.
And we're not talking necessarily accredited investors. This is what happens after an IPO is our retirement funds, us as individuals, no matter what your income or net worth is, are able to go in and take advantage of an opportunity. Isn't that right?
Yeah, that's why we really need to preserve. I mean, it's fine for companies to raise money privately, but we really need to preserve and protect our public markets as well.
I'm concerned that we're not doing that. I mean, we have half the number of public companies that we did 20 years ago, and we have only slightly more public companies than we did in 1982 right now. And we have a number of folks who have given testimony in front of this committee at different times about income disparity. And I wholeheartedly agree that that is a problem. Having a less than robust, maybe the polite DC way of putting it, a less than robust economy out there, I believe is part of that. And it was right not long ago, less than a month ago, I asked Chair Yellen about the effects and influences on regulation, on our recovery, and how shallow it has been, how long it has been, how weak it has been. She literally, look it up on YouTube, she stammered and hemmed and hawed for about 3 or 4 seconds and then said she disagreed with that. Well, we saw just this week former Chairman Greenspan came out and precisely hit the nail on the head by saying we have gone and had this over-regulatory burden. And I see Dr. Cook's reaction is not exactly in favor of that, but this sort of this rosy outlook of where the economy is it can't be a straight-faced analysis if you look at the income disparity. And it only seems that when it's in defense of the past administration that you have people talking about what a great economy we've got going on. Yeah, in my last minute here, I've got the Securities and Exchange Commission, I believe, is the police officer, the beat on the cop on the beat, that is out there making sure that investors are protected. What we have them doing now under Dodd-Frank and under so many provisions, though, is we frankly have them being a road maintenance. They're filling in the potholes and checking the street lights. When we've got them going out and doing things like figuring out rules for CEO pay ratio, rules for having conflict minerals. Can you explain to me how in the world that is advantageous to protecting an investor when we're out there doing that? When the SEC is required to protect investors, maintain orderly, fair, and efficient markets, and facilitate capital formation.
Yeah, I think with any requirement that you place on public companies, it not only places a requirement on public companies, but as you point out, requires the SEC to engage in areas that it doesn't have particular expertise in. It's very difficult. The pay ratio rule is one example of a rule that's very difficult to implement in a way that will be meaningful for investors.
And Mr. Chairman, I think that shows it just pulls their focus away from what they really need to be concentrating on. With that, I yield back.
Time of the gentleman has expired. The chair now recognizes the gentleman from New York, Mr. Meeks.
Thank you, Mr. Chairman. And first, I want to associate myself with some remarks from the gentlewoman from New York, Carolyn Maloney, because I think what she said was exactly right. Often, people forget where we've come from and what took place in 2007 and 2008, the number of jobs that was lost, how people were devastated, and why that, and that it was in fact a Republican administration that then on a transition worked with the Democratic administration to try to help fix this problem, which is why we came up with Dodd-Frank as opposed to doing nothing at all, so that we can make sure that we protect our system. In fact, if we're serious about doing this, that is a model in and of itself, because that showed a Republican administration doing a transition, making recommendations to a Democratic administration also on how we can resolve some issues to make sure that we don't get in this in the worst recession and get out of the worst recession since the Great Depression. And when we talk about in the Obama administration, the economy, as my colleague just talked about, the reason why we did talk about it is because we talked about where we've come from. You just don't change things overnight, and it took hard work to make sure that we got out of losing 700,000 jobs a month to the place where we were at least gaining, jobs again, gaining 200,000 to 300,000 jobs a month. Surely, all of us would like, in the past administration would have said, we wanted to gain more jobs. And we would need to do that over time. But yes, I would be rejoicing also if as I did, as we started beginning to reverse the depths of the recession that we were in. Now, the other issue that I want to bring up real quickly in the time that I have left, Mr. Barr, is, we are, this world is now is interconnected like never before. And I believe in your testimony, you talked about how the United States led internationally in regards to Dodd-Frank, so that we could make sure that we had some uniformity, et cetera, and therefore there was some agreements internationally. So my question to you is, can you tell us whether or not under the Wrong Choice Act, would it cause the U.S. to go back on its word on international agreements, and how that will affect us, if you will?
You're absolutely right. The U.S. really led the effort globally for financial reform really from the start, in beginning in the end of the Bush administration and continuing to the Obama administration, shaped a global financial structure that made sense for reducing risk in the system. And I do believe that moving backwards, as the Choice Act would do, on orderly liquidation, on designation of non-bank firms, in particular, would be a retreat from the global system that's developed in the wake of the crisis to deal with these problems.
Let me just ask you this, because we've got folks that's looking at this and streaming, et cetera. Just break that down for me. Break it down in layman's terms so that the average person that's listening, so if we get out of these international agreements, what kind of impact would that have on the average American citizen? That's who I'm focused on, the ones that so what kind of impact would that have on so that they could understand what you're talking about?
I think it exposes families to enormous risk of financial abuse in the marketplace. It exposes them to the risk and harm of another financial crisis that was, as Dr. Cook suggested, so brutal for American families in terms of lost incomes, lost jobs, even the ability to have enough food to eat. So if you get these things wrong, it can have a brutal impact on how people try and live their daily lives every day.
Let me go to Dr. Cook real quick, because on that same part, Dr. Cook, knowing that you've reviewed the Choice Act, what parts of the Choice Act, I know there's a lot that you can choose from, et cetera, but maybe there's one or two in the time that I have left that you might be able to single out. What parts of the Choice Act will go directly to the heart of hurting the average American citizen, the middle class and the low-income households? What do you think will most go directly to them? Because that's who I'm focused on. I don't care what part they're from, the middle class of America, the low income who needs the most help. How would this hurt them?
I think all of the provisions that weaken the CFPB and weaken the authority of the Federal Reserve to monitor and have oversight and make sure that we don't have the Wild West that we had before the financial crisis, I think this is the most onerous part. We aren't even collecting the information, or not allowing, these provisions wouldn't allow collecting the information we need critically to input into our our models or even understand what is happening in the economy. We need this information in a timely way. And I think anything that undermines that authority is not a good thing.
Time of the gentleman has expired. The chair now recognizes the gentleman from Wisconsin, Mr. Duffy, chairman of our Housing and Insurance Subcommittee.
Thank you, Mr. Chairman. I think this has been a fascinating debate today, and I appreciate the witnesses being here, but it's a conversation that I'm hearing some on the Democrat side say, well, Dodd-Frank is looking out for the little guy, and the previous system we used to have was to the benefit of the big guy, and maybe to quote Mr. Barr, he said, the Choice Act now is going to help the Wall Street titans. But I don't know if the panel can see this, but to your left and to your right, there are quotes that come up, and behind you are quotes that come up from Wall Street CEOs. Articles have been written about the Choice Act and Dodd-Frank. And I think it's interesting that the Wall Street titans, Mr. Barr, they are in opposition to the Choice Act, and they're in support of Dodd-Frank. And if I was also to talk to my community bankers, my little credit unions that serve rural Wisconsin, that like to have money from their community go to bankers in their community to then make decisions that benefit their community, those shops, those banks, those credit unions, they're closing up, or they're consolidating, and the decisions aren't made in that community anymore, but they're made in Chicago or Minneapolis or Milwaukee or Green Bay, but no longer in that community. So I would look at Dodd-Frank and go, the big titans, the big boys, they like it. The little guys, they're getting crushed by Dodd-Frank, which is the exact opposite, which my friends say was supposed to happen. I would also argue the Democrats, my friends, say that the bigger the bank, the riskier it is to the economy, the more systemic the risk. Does anybody have an opinion whether big banks have gotten bigger since Dodd-Frank or smaller during Dodd-Frank? Mr. Wallison, do you have an opinion on that?
Well, the numbers speak for themselves. Yes, the big banks are much bigger.
Have gotten bigger.
Much bigger, of course.
Because they're more, do sometimes complex rules and regulations help big guys, the big titans, and hurt the little guys? Is that a philosophy that you believe in?
Well, Jamie Dimon, who's the chairman of J.P. Morgan Chase, one of the biggest bank in the United States, called regulation a moat. And he's correct about that, because it keeps competition from challenging his bank.
So Dodd-Frank
weakens the
protects
smaller
him?
institutions.
You saying that Dodd-Frank actually protects him from competition?
Protects them from competition.
Helping the big titans on
Yes.
Wall Street.
It's easy to see, Congressman, because they have all kinds of lawyers and compliance officials and so forth to handle the
Economies of
regulation and spread it over a $2 trillion bank, and the small banks do not. So they are harmed by Dodd-Frank.
I think one of the most interesting factors when you look at the breakdown of what do the big titans believe, Mr. Barr, on Dodd-Frank versus reform in the Choice Act is look at the presidential election. Where did big banks on Wall Street give their money? Did they give it to Hillary Clinton, who supports Dodd-Frank, or did they give it to the Donald, President Trump, who wanted to do away with Dodd-Frank? They voted with their money, and they gave most of their money, Mr. Wallison, to who? Do you know?
Well, I think the statistics show that they gave most of their money by far to Hillary Clinton.
To Hillary Clinton, yes. So this argument that Dodd-Frank helps the little guy and hurts the big guy is absolutely false. It's a great narrative, but it doesn't work. You would think that when you have a financial crisis, you might actually wait for the Financial Inquiry Commission, which I think you served on, Mr. Wallison, to come out with its report before you decide what do we do to fix what caused the crisis, because we now know, and now we're going to legislate. Dodd-Frank passed before the commission even came out with its report. So now the opposition to the Choice Act is astonishing to me. I just want to, Mr. Wallison, I keep asking you questions here, but was it your testimony that government policy created the crisis in housing finance?
That's exactly right, and it's almost incontrovertible, because if you look at the data, you can see very clearly that as the Department of Housing and Urban Development required Fannie Mae and Freddie Mac to buy more and more mortgages that were subprime mortgages, that spread to the entire housing finance system, and that weakened the system substantially when the housing bubble that was created by these low underwriting standards collapsed.
One
We
more
had
quick
the
question.
crisis.
So if government policy helped create the crisis, is it fair to say that Dodd-Frank doubled down on more government policy? Yes or no?
That's what we're seeing.
Absolutely. I yield back.
Time of the gentleman has expired. The chair now recognizes the gentlelady from New York, Ms. Velasquez.
Thank you, Mr. Chairman. Mr. Barr, I agree with you. There seems to be a case of policymaking amnesia going around this room. I was here in 2008 as our nation stood on the edge of financial calamity and ruin. Try telling the victims of the Wells Fargo account scandal that we need less financial oversight, not more. Try telling hardworking families that were preyed upon with deceptive mortgages or cascading overdraft fees that this bill is the right choice for them. My position is this legislation before us is the wrong choice for consumers, for small businesses, and our entire community. Mr. Barr, I am deeply concerned about the impact the Choice Act will have on consumers in my district. According to a report from the New York City Comptroller, since 2011, the CFPB has helped more than 23,000 New Yorkers. For example, in October 2016, a Brooklyn resident filed a complaint against Navient with the CFPB regarding student loan repayment. Because of the Bureau, Navient was compelled to respond, and the individual was granted relief. Further, using its enforcement authority, the CFPB sued Navient partially on the basis of complaints just like this to seek relief for other impacted borrowers. If the Choice Act is enacted, it will make it harder for the Consumer Bureau to work with a company to help resolve a specific issue and severely restrict its ability to take enforcement actions on a person's behalf. So, Mr. Barr, how will consumers like the one I just mentioned continue to be protected in situations like this?
I think that the Choice Act would bring us back to a situation that we had before the financial crisis, where there was insufficient ways to protect American families. In fact, in many ways, it would make it worse than what we had before. I think the act would cripple the new Consumer Bureau, and there wouldn't really be anybody standing up for American families on issues like the Wells Fargo scandal or payday lending or other abuses in the marketplace. So I think it would be quite a tragedy to see that happen.
Thank you. And Mr. Barr, the Choice Act repeals the Department of Labor's fiduciary duty rule and makes it extremely difficult for the SEC to ever move forward with its own conflict of interest rule. Can you explain how these changes will continue to put Americans at the mercy of unscrupulous financial advisors?
I think that if you're offering an investment advice, you ought to have the same high standard of care of fiduciary duty, where if you're offering individual investment advice to a consumer, the consumer can rely on the fact that you're looking out solely for their best interest. That's what the fiduciary duty rule would do, and repealing it would be a horrible mistake.
Thank you. Dr. Cook, the Choice Act repeals the Volcker Rule, Dodd-Frank's ban on speculative trading and certain investments in hedge funds and private equity funds at banking entities with access to the federal safety net. Doesn't this repeal expose taxpayers to losses associated with banks' proprietary trading, which amplifies the costs associated with the crisis?
That's exactly right. And as I was saying earlier, with respect to the guarantee that is given any bank, especially if it has depositors, if it is playing with public money, then certainly it gets all of the upside and doesn't feel the pain on the downside. So certainly this repeal, I think, would not be appropriate for American consumers.
Thank you. Mr. Chairman, I yield back.
Gentlelady yields back. The chair now recognizes the gentlelady from Missouri, Ms. Wagner, chairman of our Oversight and Investigations Subcommittee.
Thank you, Mr. Chairman, and thank you all for appearing here today to discuss the merits of the Choice Act and the ways that it will help bring accountability to Washington while opening up the economy for Main Street back home. Something that I specifically want to discuss is the level that the U.S. has outsourced its decision-making and regulation setting to the international level since the financial crisis. Mr. Pollack, you referenced in your written testimony a September 2014 letter from Mark Carney, chairman of the FSB, to then Treasury Secretary Lew regarding whether Berkshire Hathaway should be designated as systemically important. Now, I understand that letter has been made classified by Treasury, but I agree with you, sir, that your statement that the letter should be made available to Congress, as well as documents about any possible agreements and decisions made at the FSB level. Mr. Pollack, going forward, should Congress demand the same level of disclosures and transparency regarding these decisions made at FSB as we would in the case of other international economic and trade negotiations in which the U.S. engages?
Congresswoman, I think that's a very important provision in the Choice Act, just as you say, and that the issue of whether American government agencies like the Fed and the Treasury make deals in international settings which they then feel compelled to follow when they get back into the American process is a very important issue, and we don't want the International Financial Standards Board telling the United States what to do, in my opinion. So I fully support the transparency and reporting required in the Choice Act of the financial regulators, and of course that includes the Fed and the Treasury.
Besides the Choice Act and the provisions that we have regarding that kind of transparency and accountability, what can Congress do to prevent further outsourcing of U.S. regulatory priorities in international bodies, do you think?
Congresswoman, I think in general, the accountability of regulatory bodies called for in the Choice Act, where Congress carries out its duty as the elected representatives of the people to oversee what the bureaucratic agencies are doing, fits in with understanding what may be going on internationally and guiding it.
Thank you very much. I couldn't agree more. It is important that the best interests of the U.S. Are being represented at the international level with full accountability, full transparency, and disclosure. Moving on, last week the President signed an executive order halting the FSOC's ability to designate non-bank SIFIs while they review the designation process. Through the Oversight and Investigations Subcommittee, which I chair, we have published a staff report and held a hearing that has shown this process has been both arbitrary and inconsistent in the past. Mr. Pollack, could you please comment on the prudence of last week's executive order?
Congresswoman, I remember the hearing very well, which you chaired and I had the honor to speak in. I think it's quite true what the staff study found, that the FSOC's decisions were inconsistent, arbitrary and capricious, as the judge said, and it's because the decisions are fundamentally political, judgmental decisions, and they shouldn't be delegated to a committee which is not even a committee of agencies, although it would be under the Choice Act, but a committee of individuals who happen to head agencies. So I think what the executive order said and what the Choice Act would provide here and what your hearing showed are all correct.
Political and judgmental. Sir, should FSOC even have authority to designate these firms, and how does the Choice Act help curtail this power that seems to enshrine this status of too big to fail for certain firms?
Congresswoman, I concur with the idea they should not have such authority, and that we'd be better off moving in the direction of the Choice Act where they would not have it.
Mr. Walson, should FSOC have this designation authority for non-bank SIFIs?
Sorry, certainly not. Should not have that authority. It has abused that authority so far, and it will continue to do so if it's left with that authority. Unfortunately, they have been implementing in the United States decisions of the Financial Stability Board in Europe.
Absolutely correct. Thank you very much for your testimony.
Time of the gentlelady has expired. The chair now recognizes the gentleman from Missouri, Mr. Clay, ranking member of our Financial Institutions Subcommittee.
Thank you, Mr. Chair, and thank you for conducting this hearing. Let me thank all of the witnesses for being here. We've heard a lot of back and forth from my friends on the other side, as well as from the witnesses here. But let me see if I can inject some of the facts before we move forward. And I have a letter here from the CEO of an American bank, a community bank, who said that the lending and credit markets are on a hot streak. Credit card lending is higher than it's been in 6 years and just hit a record high of $996 billion at the end of last year. Auto loans peaked at over $1 trillion in the fourth quarter of 2016, up from $634 million in the same quarter of 2010. Mortgage rates fell to 3.65% by the end of 2016, down from 4.69% in 2010. The recession caused by 2008's financial collapse tore apart these industries, left millions of Americans out of work, and obliterated any and all trust in the country's largest financial institutions. We are finally seeing true recovery and growth again, under the watchful eye of careful regulatory oversight and in the wake of years of careful policy making designed to encourage recovery while preventing the country from ever experiencing a crisis of that scale again. Yet, even as we watch this progress continue, some federal lawmakers insist that regulations formed in the wake of the crisis are holding markets back, claims which fly in the face of reality. These lawmakers are demanding a rollback of the Dodd-Frank Reform Act, despite the protections it offers to both consumers and our national economy. The opponents of oversight and regulation insist the red tape of Dodd-Frank's reforms are driving up mortgage and credit costs for consumers, even though the costs are consistently hitting record lows. An American Banker piece published recently used the figures above to dispel these falsehoods about the lending industry, proving Dodd-Frank is not holding back opportunities for consumers. In reality, interest rates on mortgages are at a long-term low point. Mortgages are being given more freely than at any point since the crisis. Auto lending is already well above pre-recession levels, and auto loan rates are lower than they were in 2010. And then he goes on to say, it's difficult to argue with the point that scrapping Dodd-Frank would make it easier for banks to issue credit and loans. However, the protections offered under this law are the only thing standing between consumers and the predatory lending practices which fomented the greatest economic crisis in 70 years. Dodd-Frank helps prevent any small handful of banking institutions from holding the keys to the country's economy by limiting investments by banks and forcing accountability to federal regulators. We are preventing the rebirth of the too-big-to-fail institutions. And this is from the CEO of Amalgamated Bank, which I would like to submit and have it included in the record.
Without objection.
Thank you. Mr. Barr, do you agree with the writer of this letter?
I don't know all the details in the letter itself, but in the biggest picture sense, yes. I think the lending markets are quite healthy in the United States today, and one of the reasons for that, in comparison to, say, Europe, is that we took swift action in the wake of the crisis to reform and build capital. And I think all of our panelists are saying that more capital is good. We have differences beyond that.
Thank you so much for your
Time of the gentleman has expired. The chair now recognizes the gentleman from Kentucky, Mr. Barr, chairman of our Monetary Policy and Trade Subcommittee.
Thank you, Mr. Chairman. Thanks to all our witnesses for your testimony. And I'd note that a number of our witnesses are either lawyers or law professors, and want to ask you a little bit about Article I powers in the Constitution as it applies to the Dodd-Frank law. As you all well know, Article I, Section 1 of the Constitution provides that all legislative power shall be vested in a Congress. And we know in law school that they teach us in constitutional law that's known as the non-delegation doctrine, which has been interpreted creatively by the judiciary to allow for delegation to unelected, unaccountable executive branch officials over time. That practice has exploded under the Dodd-Frank law, and in fact, most law is now actually written by unelected bureaucrats as opposed to elected representatives of the people here in Congress. My question to Mr. Pollack and Mr. Wallison, does the massive delegation of authority to federal bureaucrats concern you?
I'll go first. Yes, quite a bit, actually. You take, for example, what the FSOC is supposed to do. The FSOC is supposed to determine whether a particular company, at some time in the future, in a time unknown, could not possibly be known, could, if it collapsed or had material financial distress, would cause a financial crisis. In other words, they are being asked to make a decision about something that no one can possibly know. So, of course, they struggled with all of this, and when they finally designated MetLife, MetLife went to court, and the judge, the district judge here in the city, looked at it and said, this is not possible, this is arbitrary and capricious. That's the kind of decision that the Dodd-Frank Act has put before the American administrative groups and the executive branch, and that, to me, is a delegation of legislative authority. It was Congress that should have made those decisions.
And Mr. Pollack, in answering that question, why is it important that key policy judgments be made by those who define legal rules and not by those who enforce the rules?
That is the most fundamental constitutional idea, as you suggested in your comments, Congressman, that it's the elected representatives of the people who make law. And as I said in my testimony, the regulatory agencies are derivative bodies derived from the Congress, responsible to the Congress, and I'm delighted to see the Choice Act having the Congress step up to carry out their governance responsibility of these agencies.
Ms. Peirce, I appreciate your testimony that good rules require good process, and in reference to the structure of the CFPB under Dodd-Frank, and in reference to the D.C. Circuit decision and PHH, can you tell us a little bit about why the structure of the Bureau in insulating that Bureau from political accountability, why that's a bad idea, and how that may produce anti-consumer policies? And in answering that question, could you respond to the refrain we hear from the apologists of Dodd-Frank, the defenders of Dodd-Frank, that, oh, we need to insulate the Bureau and the director from political accountability? It needs to be an independent agency.
Yeah, the notion that independent of accountability will produce better regulation is false. We've seen the PHH case is actually a great example because the underlying facts of that case are fairly stark. So even if you take away the constitutional concerns and look at what was actually done in the case, changing the law midstream essentially, and applying a retrospective penalty that increased dramatically when it got to the director's level shows the kind of due process concerns that you can have. So the idea that one man is going to be able to make consumer decisions for all the consumers in the country is troubling, especially when that person doesn't experience the circumstances that a lot of people experience and doesn't have the limited options that people have. And so from his perspective, he may not understand that constraining the options even further is making life even more difficult for people.
Let me ask the question this way. Is the public interest, is the interest of the consumers best served by the people's representatives or by those who are fundamentally unaccountable to the people?
I think that that's what you need to have. You need to have appropriations and you need to have other powers so that Congress can monitor what the agency is doing and bring in the public interest.
Thank you for your testimony. Yield back.
Time of the gentleman has expired. The chair now recognizes the gentleman from Georgia, Mr. Scott.
Thank you very much, Mr. Chairman. I was an original co-sponsor of Dodd-Frank, and I remember that we had exactly 41 hearings before the House passed its version of Dodd-Frank. But today, it seems to me, unless I can be corrected, we have only a single hearing on this issue, and I assume this is it. I happen to believe that the American people deserve much better than this. This Choice Act goes underneath all of the elements of our complex, complicated financial system. And to give it only one day, one hearing, is not fair to the American people. It doesn't take a historian to remember the amount of jobs we lost. Sometimes we lost as much as 600-700 jobs a month. Retirement savings of American citizens, millions, went down the drain. And the amount of foreclosures was devastating. And the thing that disturbs me is that this should be a very definitive Republican and Democratic partnership working together. And let me remind the committee and the people of this nation who might be listening, every major piece of public policy that's been sent forth have had both Democrats and Republicans working on it together. Social Security started way back, but we had people working on it together. Even our highway system, the interstate highway system, by a Republican president, Dwight David Eisenhower, but they were Democrats and Republicans working together. I could go on to cite even the Civil Rights Act. It was Democrats and Republicans. And need I say, if it weren't for Everett Dirksen, we would never have been able to pass some of this legislation. So I just wanted to set the stage on that, because I don't think there's been any Democrat on this side of the aisle that has reached over to that side of the aisle and worked together. And I want to appeal to Chairman that before we move this bill out, to have some additional hearings, and I think the American people certainly deserve that. But I do have some very, very pressing concerns. One is the capital requirements, Title I, under this act, to bring about this area of accountability and to simply base it upon certain data that has been collected that might not be the case. The off-ramp, auditing the Fed, which would handcuff the Fed. So in my last minute, Dr. Cook and Mr. Barr, you all touched upon this. Am I right about what I am saying? Dr. Cook, and then Mr. Barr?
You're absolutely right about what you're saying. there is a lot of forgetfulness about the effort that went into fighting this financial crisis. And I'm not sure I understand from the conversation. There is a lot of disparagement of economists and expertise and people who've been working on these tools for a long time. I guess I'm the only macroeconomist here. Maybe I feel under siege. We work very hard. These people who are being described as bureaucrats who are undemocratically making these decisions, they are just PhD economists who want to do a good job, who think about the spirit of public service. So I think that they would be interested in making sure that the system was safe and sound and stayed that way.
Thank you. Time of the gentleman has expired. The chair now recognizes the gentleman from Florida, Mr. Posey, for 5 minutes.
Thank you, Mr. Chairman. Mr. Wallison, an important yet perhaps overlooked provision of the Choice Act would limit donations made pursuant to settlement agreements to which certain departments or agencies are a party. Section 393 of the Financial Choice Act would prohibit federal financial regulators from using settlement proceeds to make payments to third parties who are not harmed by the wrongdoing that led to the settlement. I mean, that seems like a no-brainer. And now I think the vast majority of American people believe that when the government enters into these settlement agreements, those funds are reserved solely to compensate the actual victims. But as we learned from the previous administration, that's not always the case. Over $3 billion, with a B, dollars in settlements have been pilfered from victims and sent to special interest groups since 2014. For example, the National Council of La Raza, the controversial left-wing advocacy group, received $1 million in grants under a mortgage lending settlement despite not being harmed by the activity in question. Community development groups and other political allies of the previous administration have also benefited from these settlements, receiving de facto federal funding without the approval of Congress. Because enforcement agencies cannot unilaterally disperse settlement proceeds to third parties, they have instead directed the banks to donate funds to various groups as terms of their settlement agreements. And even worse, the previous administration actually incentivized companies to donate to unharmed third-party groups by doubling such donations, the credit such donations would have toward paying down their settlement obligations. In these situations, the consumers, the victims of the alleged wrongdoing, end up losing because funds would have otherwise gone to them. Mr. Wallison, beyond the moral and ethical questions of this practice, can you discuss the constitutionality of these settlement slush funds and whether or not this practice violates, at least in principle or spirit, the appropriations power reserved for Congress and therefore the separation of powers? And finally, do you believe this provision in the Choice Act is an appropriate step toward correcting this problem?
Yes, Congressman, I do. I think this is something that this committee should be quite concerned about. There was an investigation by the Wall Street Journal last year, a very thorough investigation, to find out what happened to over $100 billion in settlements that the government had made with the large financial institutions, and they found that $45 billion of that went to the victims, but they could not determine and did not determine how it went to the victims, because I suspect that there weren't lawyers from the Justice Department standing on street corners taking applications. I suspect that what happened is that most of this money went to people who said they represented the victims and would make sure that the victims were suitably reimbursed. I think this is a serious problem because that money should have belonged to the American people and should have been appropriated by Congress. And I'm quite unhappy with the way that that whole process was looked at by the previous administration.
Yeah, I know. I tried to get copies of some consent decrees to try and follow the money, and the Justice Department refused to provide me the information. To this day, I'm still not able to get it. I'm glad the Wall Street Journal at least could get some of it. Dr. Michelle, in keeping with the important check that the power of the purse provides Congress, the Choice Act would subject the CFPB to regular appropriations. As you know, currently the CFPB requisitions money from the Federal Reserve to fund its operations. Congress cannot review or direct how the CFPB uses that money. What inherent problems with allowing an agency to avoid Congress's power of the purse? And conversely, what are the benefits of ensuring agencies must justify their spending to the people's representatives in Congress during the appropriations process?
Well, I think it's important to know that any and all federal agencies should be directly accountable to the people through their elected representatives. So any process that keeps them, that puts anything in between that, and then that slows that process down or makes that process more difficult is bad. The FTC is a good example historically of an agency that was reined in by Congress through the appropriation process when they were doing what they were not supposed to be doing. And I could envision how that could happen again with something like the CFPB, were it the case that those protections were in place. And it's very important. It's the only mechanism that the people have.
Thank you. Thank you, Mr. Chairman.
Time of the gentleman has expired. The chair now recognizes the gentleman from Massachusetts, Mr. Lynch.
Thank you very much, Mr. Chairman, and to the ranking member as well. And thank you to our witnesses for your willingness to help the committee with its work. I have to admit I'm very concerned with this bill that we're discussing today. I have to say that the Financial Choice Act of 2017 is probably the worst bill that I have seen in my time in Congress. And I'm not new, but it is a compendium of just bad ideas. It's actually breathtaking in the naked purpose of this bill to benefit the big banks in this country at the expense of the American taxpayer. I got to give you credit, Mr. Chairman, and my colleagues on the other side of the aisle. I have never seen so many bad ideas jammed into one bill. This is really an accomplishment. I'm not sure you should be proud of it, but the bill is what it is. This essentially repeals Wall Street reform. Okay, and I was here when the market went in the toilet, and I'm familiar with the reasons why it did so. I'm a Democrat who voted against the bailout because there were folks in my district that didn't even have a bank account, and we had to give the people who caused the problem billions and billions of dollars at their expense. And now we're going to go back and do the same thing again. And we're just about out of there's some towns in my district that haven't yet climbed out of the last recession, and we're paving the way to the next one. It's just a very, very bad idea. So this bill repeals the Volcker Rule, which stops banks from gambling with taxpayer money and depositors' money. It repeals the Orderly Liquidation Authority, which was a mechanism that we adopted to prevent future bailouts, and which would allow any mega financial company to fail in a way that didn't damage the wider economy. Mr. Barr, I appreciate you being here and your thoughtfulness, as well as Dr. Cook. Mr. Barr, as you know, Section 901 of this legislation repeals the Volcker Rule. And there's a study that was authored by the International Monetary Fund, and that disclosed that the 73 banks identified currently as systemically important by the Basel Committee on Banking Supervision account for nearly 2/3 of global assets, according to the study. And these institutions pose management challenges and are very, very difficult to regulate, supervise, and resolve in an orderly manner in the event of a failure. Can I ask you, what would the repeal of the Volcker Rule do to the ability of regulators to manage the risks in the financial system due to the proprietary trading and sponsoring hedge funds and other risky activities? What would that do?
I think it would make it much harder to manage those firms, harder to supervise them, and harder to resolve them if they got into trouble. So I think these kinds of structural barriers that slow down the transmission of risk from one institution to the other can be effective as long as you're sure to regulate the shadow banking system and not say, well, as long as it's going on over there, we don't care about it. So if you have a system that really regulates both banks and shadow banks, I think those kinds of structural separations can be quite useful, including the Volcker Rule.
Thank you. Dr. Cook, do you have any thoughts on that?
No more than what my colleague has said.
Okay. Now, the same people who tried to kill the Consumer Financial Protection Bureau, they want to put the funding necessary for that agency subject to the appropriations process. So they've already tried to kill it. Now they want the ability to defund it. Any idea what the ramifications of that might be if that were to come to pass as this bill suggests, Mr. Barr?
I think it would be a mistake to put the CFPB under appropriations. I think the system we have for the OCC and the Fed and the FDIC, insulating it from the appropriations process is appropriate, and I think the CFPB should be treated the same.
Dr. Cook, do you have any feelings on that?
I just agree.
Okay, very good. All right, I have 20 seconds left. I just want to say what a horrible bill this actually is. You know, it's amazing. I hope that people are paying attention at home and they understand what's going on in this committee. It affects every home and business in America today, and you should pay attention to this stuff. Thank you. I yield back.
Time of the gentleman has expired. The chair now recognizes the gentleman from California, Mr. Royce, Chairman of the House Foreign Affairs Committee.
Thank you, Mr. Chairman, Mr. Allison, and Dr. Michelle. I just want to follow up on the questioning from my colleague, Mr. Duffy. And my primary concern, I'll just explain here, has to do with the regulatory weight that we have placed on community banks, on smaller financial institutions, on the credit unions, and so forth. And simply due to economies of scale, we have put them at a significant disadvantage so that the smaller the institution, the larger the disadvantage, which is a backwards equation. And I think any of us who've talked to our local community banks understand this. And my question for you is, what is the real-life impact thereby on a borrower seeking a loan? We were all on board, of course, with increased underwriting standards, no more low-doc or no-doc loans. But it seems that we've moved closer to what we would all consider a utility model here. We're not letting bankers be bankers. We've moved to sort of a utility model that puts increased regulatory burden on local banks and credit unions. They're not the ones that created the crisis, while at the same time taking away the one advantage that they had over their competition because they knew their own customers. So if they were going to be allowed to be bankers, they could work out the loans, not when you've got this kind of regulatory environment. So let me ask that question. How does the current regulatory environment created by the current version of Dodd-Frank affect constituents in Southern California who are seeking a loan?
There's no question that it makes it more difficult for consumer banks to do their traditional, what I call small business venture capital lending, which was the core of their business. That's where you look at financial information, but you judge an individual, the market, and the idea. The Federal Reserve has put intense pressure on mathematical modeling, which a lot of these loans don't make it, and a lot of loans that I made that have turned out very successful wouldn't have happened. In addition to the direct cost, I grew up in a small bank, and the CEO has to do a lot of this regulatory stuff himself. And the CEO provides a disproportionate amount of the intellectual talent in a small bank. And if he or she's spending their time doing regulation, instead of out in the community looking for opportunities to make the community grow, then you have a really serious misallocation of resources. And you see that in a lot of small communities today.
Or if you have performing assets.
Yes.
And the regulatory approach here says write them off.
Definitely. And it hurts the growth in those communities. I think it is a big problem for small communities.
There's another aspect of this that I've worried a lot about, and that is because of the economies of scale, they're going to be ripe for being bought by the larger financial institutions. Wouldn't that over time? And I think this was Mr. Waller's argument some years ago. I heard him lay out this case that if we're worried about over-leverage, why would we create a situation where the burden on the smaller institutions are such that they're going to be bought out by larger institutions who then will be in a position without the competition to further over-leverage. And that's the kind of over-leverage we were really worried about in the first place. Let me ask you about that.
Yes, sir, I think that definitely happens. And one of the ironies, we've made it so hard for banks to start because ultimately what's been happening in the community banking industry is some community banks are getting sold.
So that's why we're not seeing any new banks or credit unions.
They can't get started.
Yeah. Well, a quick follow-up. My colleague, Mr. Williams, has introduced a bill that would encourage greater use by the CFPB 1022 exemption authority. Do you believe that Director Cordray has correctly interpreted the Bureau's authority and used it appropriately to prevent overburdening small community banks, smaller credit unions?
No. I mean, in theory, community banks are supposed to be exempt, but in practice, they're not, and that's just the way regulators act. They're not going to exempt community organizations.
I was going to ask Ms. Pierce, I was hoping you could also put to rest the idea that the AIG was a failure only of federal regulation of the financial products unit. You've researched the role AIG's securities lending program and the failure of state regulation on this front had, and maybe you could opine on that for just a second.
Yeah, AIG was about much more than derivatives, which people like to portray it as. There was a failure of the state insurance regulators as well. And so the solution in Dodd-Frank was not appropriately tailored for the actual problem at AIG.
Thank you. Thank you, Mr.
Time of the gentleman has expired. The gentleman from Minnesota, Mr. Ellison, is recognized for 5 minutes.
All right. Thank you, Mr. Chairman. Thank you to the ranking member. Mr. Wallison, I have a question to you. During your role as a member of the Financial Crisis Inquiry Committee, you continually claimed that Fannie and Freddie Mac were responsible for the financial crisis. My question to you is, I'd like to ask you about a July 13, 2011 report published by the Committee on Oversight and Government Reform. The report was entitled An Examination of Attacks Against the Financial Crisis Inquiry Commission, and I request permission to submit the report for the record.
Without objection.
On page 11 of the report, it says that you use your position on the commission to promote a theory supported by Representative Issa and put forth by Edward Pinto, a resident fellow at the American Enterprise Institute, that was ultimately rejected as flawed by every other member of the commission, namely that government housing policy was a primary cause of the government's economic crisis. The report also notes that your fellow Republican commissioners thought you were really just a, quote, parrot for Pinto. I guess my question is, you're offering your testimony here so that, I guess it could be believed, but, how do you react to your fellow members of the commission making the observations that they made about your work?
I don't want to really refer to my work, but I can refer to the commission, and I think my work will stand up over time. You can also look at my book on the subject, Hidden in Plain Sight.
Okay, thank you for your answer.
Which,
I think that's sufficient.
Wait a minute, I do think
No,
I'm
it's my
entitled-
time, and you're sufficiently answered. Thank you.
Am I not entitled to answer what you just said?
You have answered.
The time belongs to the gentleman from Minnesota.
Thank you. Also, Mr. Watson, was your compensation at the time you served on the commission or after your service tied in any way to you magnifying the beliefs of Mr. Pinto?
No.
Okay. Also, did you receive a warning from the General Counsel that you violated the confidentiality requirements to serve on the Financial Inquiry Commission?
I received a statement by the members of the commission that I had not observed the confidentiality requirements of the commission at one point.
Okay. And how do you respond to that observation that you had confidentiality expectations that you didn't meet?
I don't think they were applicable to me.
Okay. Dr. Cook, could you talk about there's been a lot of discussion around the role that Fannie and Freddie played in the financial crisis of 2008. And as I look at the Choice Act, or the Wrong Choice Act, I couldn't find anything that addresses Fannie and Freddie directly. Did you see anything?
I have seen something. Bostic and co-authors, and I think it was 2012, had a paper, an extensive paper. So this is Raphael Bostic, who is now the president of the Atlanta Fed, but a colleague from the University of Southern California who looked into this in depth to see what the role was. And it said that it didn't have an outsized role in forcing this financial crisis. So I think that I would agree with what you're intimating by your question.
Okay, but in the bill that's before us, and I'd encourage Mr. Barr to offer his views, I was looking through the bill, I try to read all the bills. I didn't see any provisions directly bearing on Fannie and Freddie. If it's such an enormous problem and it caused so much damage, you would think that it would focus on the Choice Act, the Wrong Choice Act would focus on it, and yet I did not see where the Choice Act addresses fixing the problems of Fannie and Freddie. Mr. Barr, would you like to comment on this?
I'm not aware of any provision of the Act that takes on the question about the future of Fannie Mae and Freddie Mac.
Well, wait a minute.
Things around the edges.
It's a huge problem, and it caused all the catastrophe. I mean, shouldn't it be the central focus of this legislation?
I was surprised that it was not a central part of any approach here.
Well, that's all the time I have, and I want to thank the entire panel, including you, Mr. Wellison. Thank you very much.
Time of the gentleman has expired. The chair now recognizes the gentleman from Illinois, Mr. Holtgren.
Thank you, Mr. Chairman. And I just want to say thank you for all of your work, Mr. Chairman, of getting us to this point. And I want to thank everyone on the panel for being here as well. Before I get into my questions, Mr. Wallison, wanted to see if you wanted a minute to respond to anything from the previous question. Wanted to offer that first. If there is anything that you want to respond, you weren't given much of a chance to answer.
I wasn't. Unfortunately, the Financial Crisis Inquiry Commission was a poorly run operation, and all of us, the members, did not see all the data that the staff of the commission had. We did not get a copy of the report until the final report, until 9 days before it was supposed to be published. After the commission ended, I was able to go back and look at some of the files that they had, and I found that much of the material they had in their files and the material that they ignored supported the position I had been taking all along, which was that the financial crisis was caused by government housing policy. I've since written a paper that is available on the AEI website, and anyone could have a look at that to see how the commission distorted the facts in order to achieve something that they wanted Congress to follow up.
Thanks. I do want to ask my first question to Ms. Pierce, if I may. I understand there's some consternation regarding Section 844 of the Choice Act. I'd like to use this opportunity to clear up some of those concerns. One purpose of this provision is to update the resubmission thresholds and holding requirements for shareholder proposals to prevent only those proposals with very little or no support from continuing as a nuisance every year after they've already been denied by the vast majority of other shareholders. For example, I can't believe investors' need for Boeing to adopt healthcare reform proposals, for Mondelez to report on gender equality through the entire supply chain, for McDonald's to educate the American public on the benefits of genetically modified products, or for Archer Daniels Midland to adopt and implement a comprehensive sustainable palm oil policy. These social objectives, for which I agree there could be some merit in addressing, have nothing to do with investor protection or capital formation. The resubmission thresholds in the Choice Act, I think, are reasonable. They were actually proposed by SEC staff in 1997 under the leadership of a Democratic appointee, Arthur Levitt. The Association for Corporate Secretaries testified in the Capital Markets Subcommittee last year that, and I quote, the so-called failure rate under the 3, 6, 10 threshold of 1997 would compare to current voting patterns under 5, 15, 25%, end quote. So all of that, am I missing something here? Is there the purpose of our securities laws for job creators to constantly respond to proposals with almost no support? Shouldn't the SEC be focused on capital formation and real investor protection, not social issues? And furthermore, from an investor protection standpoint, if people feel very strongly about these social issues, don't they have the choice to invest in other companies that they feel are addressing these concerns?
Yeah, shareholder proposals have become a big consumer of resources, both of SEC staff and of company resources, and ultimately shareholders pay the cost. And so putting in, revisiting the resubmission thresholds is one way to make sure that investors are not paying for companies to respond to these each year.
Ms. Pierce, on page 2 of your written testimony regarding administrative procedure, you highlight some of the reforms the Choice Act proposes for the SEC. In general, can you discuss the importance of the rule of law for accountability in the investigation and enforcement process of this agency? Furthermore, wouldn't it be logical to also make identical reforms to the CFTC?
Yeah, I think due process is not only valuable for the target of an enforcement proceeding, but also for our country as a whole to know that when an agency pursues an individual for a violation, that it's following all the proper procedures and affording all the proper protections. And so I think that some of the changes that the Choice Act makes do this and could be extended to other agencies as well.
Mr. Wallison, there has been some concern about the lack of clarity between proprietary trading and permitted activities such as market making and hedging. How do you draw the distinction between proprietary trading and market making and hedging, and what are the consequences of not having a clear distinction between the banned proprietary trading and permissible market making? Have any of the regulators addressed these concerns?
The problem is that you cannot draw a line effectively between proprietary trading and market making. That caused many years of dispute among the regulators who were supposed to draft the appropriate regulation. They finally put one out, but it still hasn't solved that problem. The two look very much alike when you consider what they are, and as a result, the banks, in an excess of caution, have stopped doing what they should do to make markets.
My time has expired. I yield back. Thank you, Chairman.
Time of the gentleman has expired. The chair now recognizes the gentleman from Maryland, Mr. Delaney, for 5 minutes.
Thank you, Mr. Chairman. My questions are for Mr. Wallison, but before I start, I want to comment on Mr. Allison's testimony, which I thought was very thoughtful. I have long thought that in the rating of banks, the C in camels and the M in camels should be way overweighted relative to the other categories because capital does solve many problems. I'm not sure I agree with the conclusions. I don't think the reasons we've had such tepid economic growth is because of banking regulations, recognizing, however, that we should be doing things to provide relief to community banks, and parts of FSOC, I think, are overreaching, and there are clear things we should be doing to this regulation to get more at the spirit of what you laid out in your comments, but I thought they were very thoughtful. And Mr. Wallison, I think my question to you kind of ties into my colleagues from Minnesota's question, which is, the reason we're not fixing Dodd-Frank, which is what, in my judgment, we should be doing, anytime we do a transformative piece of legislation, whether it be health care or financial regulation, the Congress should sign up for 10 years of fixes, right? Because we shouldn't presume we got it right on the day we dropped the bill. And we haven't been able to do that with Dodd-Frank, and I think the Choice Act is also a step backwards in that direction. I would much rather this committee be focused on fixes to Dodd-Frank as opposed to repealing it. But the repeal seems to be based on two premises. First, that Dodd-Frank has caused us to have reduced economic growth since it was put in inception. I don't buy that argument. I think U.S. banks have generally done pretty well. They've gained market share relative to their foreign competitors. Liquidity in U.S. markets is quite strong. However, small community banks have clearly been, in my opinion, hurt by the law, and they are not providing credit at the levels they could in the market. But if you look at the percentage of the market small community banks have, and even if you were to assume they were to be providing 50% more credit, it wouldn't move the needle that much, in my judgment. But the other premise is that somehow the government caused the financial crisis, and therefore, if that's true, then the government shouldn't be responding to it. And that's where I have issues with your testimony, because you seem to believe that the reason the financial crisis occurred was because of the U.S. government, and you said that in your testimony. And so my question to you is, 19 of the 20 largest financial institutions that existed in the United States right before the financial crisis either failed or required a massive injection of government capital, 19 of 20. It's hard to trace what actually caused the financial crisis, but it's clear that one thing was a main contributor to it, and that is that the market, the private market, whether it be the credit rating agencies, risk managers in private financial institutions, and the government, whether they be regulators or these quasi-government institutions, Fannie and Freddie, had a view that mortgage securities were as safe as U.S. Treasuries because they were treated almost interchangeably on the balance sheets of these financial institutions, which caused excess leverage in the system. How is that the fault of the U.S. government?
This is a very complicated question, but...
No, it's a simple question. How did the government somehow kind of put the private market in a trance that mortgage securities were as safe as U.S. Treasuries? How is the government responsible? Because clearly the market thought that, because they leveraged them accordingly, they repackaged them accordingly, and they treated them accordingly. How is that the government's fault?
The underwriting standards of Fannie and Freddie were forced to decline by the affordable housing goals. When you reduce underwriting standards, you cause a bubble to start growing. Let me give you an example of that.
So you think the private market doesn't have any responsibility for determining whether underwriting standards have been reduced and whether, in fact, mortgages are riskier? You think that's the government's problem?
Fannie and Freddie set the underwriting standards for the housing finance market because they were by far the largest buyers of mortgages. So if you wanted to compete in that market, you had to make the kinds of mortgages that Fannie and Freddie wanted. That's why the underwriting standards across the entire market declined.
So it's the government's fault that market participants engage in irrational business practices for competitive gains?
It wasn't irrational because Fannie and Freddie were buying these mortgages. They were happy to buy them. And you could profit from making these mortgages and selling them to Fannie and Freddie and also FHA.
But a lot of mortgages were bought by things other than Fannie and Freddie. They were bought by securitized instruments.
Yes, that's...
At the peak of the financial crisis, 18,000 securitizations had received a AAA rating. Only 8 corporations in the world had attained a AAA rating. So it took the history of the world and all the corporations in the world, and 8 of them made it to a AAA. Yet 18,000 mortgage securitizations had a AAA rating.
Well, now you're talking about the rating agencies. That's a whole other story. But the fact is that they used a model.
You're assuming the government made the rating agencies misunderstand
Mr. Chairman,
risk
unanimous consent for the gentleman to have one more minute.
Jack, the time of the gentleman has expired. The chair now recognizes the gentleman from Florida, Mr. Ross.
Thank you, Chairman. I thank you very much for holding this important hearing. I firmly believe that we must enact many of the important reforms contained in the Choice Act. We need to unlock financial growth and opportunity once again in this country. I support the provisions of this bill that increase accountability of both Washington and Wall Street. For example, I support the Department of Labor's repealing the Department of Labor's flawed and misguided fiduciary rule. I support the provisions of this bill that will help financial institutions, especially smaller institutions that have had too many burdens placed on them over the years. I support the provisions that require the restructuring and accountability of the CFPB. Yet there is a provision of this bill that I must express my concerns, and that is the provision that would repeal debit reform. I've heard from directly from a broad spectrum of the retail community in my district, and even from my manager at public supermarkets at my hometown where I shop, about the need to maintain debit reform. Just last night, I had the opportunity to sit down with an old friend, Wogie Badcock III, who is the Executive Vice President of Public Affairs for Badcock Home Furniture and more. Wogie's in the room today, and he's here because of the importance of this debit reform to his family furniture business, which was started in 1904 by his grandfather. The savings that they've realized from debit reform has allowed them to hire more employees, open more new stores and distribution centers, and even pass along some of the savings to consumers, benefiting consumers. In fact, since the enactment of debit reform, Badcock Home Furnishing and More has used those savings to open up more than 30 stores in the last 5 years across the Southeast. This is significant. With that in mind, Mr. Chairman, I'd like to take a moment to enter the attached letters from the Food Marketing Institute, the National Retail Federation, the Merchants Payments Coalition, and a joint trade letter into the record that represent 170 national, state, and local trade associations and 900.
Without objection, without objection.
Thank you, Mr. Chairman. Now I'd like to move on for you, Mr. Wallison. I find it really interesting that here we have on FSOC one member, a voting member, who has insurance expertise and yet is ignored, is so much ignored that we create this this idea that somehow or another in the non-bank financial institutions, such as an insurance company, that they're going to be the subject of a run on an insurance company that's going to lead to the demise. Would you not agree then that we should allow for the best system that we have, which is our state system of regulation, to continue to be that which not only protects our consumers, but also allows for solvency and capital requirements to make sure the best products are available for our consumers, and not have SOC being that faux umpire?
Well, yeah, the state system of insurance regulation has been very successful over time. I don't see any reason we would have to change that.
I agree. And well, go ahead.
The FSOC, as I said earlier, I think the FSOC was simply implementing the decisions of the Financial Stability Board in Europe, which declared AIG, Prudential, and MetLife to be GSIBs.
Yeah.
As a result, they simply put those into effect.
And they just rubber stamped it.
They were rubber stamping what the FSB was doing.
And we know what the courts have said, and that's good, and I think that's what's very good about this bill is it does away with that. But let me get back to something that my colleague from Maryland, Mr. Delaney, was just talking about, and that's rating agencies. When we look at too big to fail, when we look at organizations that are so large that they are going to be subject to bailouts from the government, would not a rating agency consider that in terms of them giving them their rating? So much so that they would consider it to the detriment of one that was too small and allowed to fail, that the bigger one, the too big to fail, would have an unfair competitive advantage.
Yes, that's exactly what happened with Fannie Mae and Freddie Mac,
Exactly.
which were not supposed to be.
Mortgage-backed securities, and they knew they were backed by the federal, full faith and credit of the federal government. So why not give them a AAA rating? Why not give them what they want? Because the federal government stands behind it. If that doesn't create a disincentive for a strong economy, I don't know what does. It creates the moral hazard that we're here today trying to correct with the Choice Act.
You're completely right.
Thank you. I should tell my wife that sometime. Mr. Allison, you mentioned earlier in your testimony, and I appreciate your experience in the banking industry, and I really do, because I think you did something that was tremendous with regard to the financial meltdown. As you withstood it, you withstood strongly. You didn't have any damage because you did it right. You had capital requirements. You knew what to do. But you also mentioned in your testimony that the regulatory burden imposed by the Dodd-Frank Act has a negative impact on lower-income Americans. Can you expand on this in 10 seconds?
To the degree that consumer banks are focused on regulations instead of taking care of their customers, or big banks are focused on regulations instead of their customers, the customers get worse service and pay higher prices. At the end of the day, all cost gets passed to the customer.
Thank you. My time is up.
Time of the gentleman has expired. The chair now recognizes the gentleman from Texas, Mr. Green.
Thank you, Mr. Chairman. Friends, if you like kickbacks, you will love the Choice Act, because it will allow hardworking Americans to go into a lending institution to acquire a loan and receive an indication that he or she has qualified for a loan at 8% when they actually qualified for a loan at 5%. Dodd-Frank ended what was called the yield spread premium, which allowed hard-working people to qualify for loans at a lower rate and be put in a loan at a higher rate, and the person doing it suffered no consequences at all because it was lawful. So if you like that kind of kickback scheme, you will love the Wrong Choice Act. It allowed people to find themselves in a circumstance where they were paying more for a loan than they should have been. There were more defaults than we should have had. It was a bad circumstance that Dodd-Frank eliminated, the so-called yield spread premium, but it really was just another kickback. If you want to see a real setback, then choose the Choice Act. because the Choice Act would allow investment bankers to take your money that you've deposited in a bank, go out to Wall Street and gamble with it, and if they make a profit, they get to keep it. They'll call it proprietary trading. They'll get to keep that profit. And if they lose, then the FDIC bails out the bank. It's a bad bill. It allows hardworking Americans to be ripped off with impunity. Ms. Cook, would you kindly give your explanation in terms of how the so-called yield spread premium, the kickback, had an impact on hardworking Americans?
One manifestation of that was when this was used to put especially African Americans and Hispanics into mortgages that were actually lower, in lower quality mortgages than they deserved from their credit score and other information that would have gone into a mortgage decision. So this was absolutely rampant. We're still finding more cases of that from this period, but yes, it was used in a widespread way.
And actually, there is no way to really measure how much damage it did. There's no way to adequately determine the suffering. I see a person of the cloth here. You have no way of knowing how much suffering took place because of this so-called yield spread premium that the Choice Act will again allow. Mr. Barr, explain, if you would, for us as tersely as possible, how allowing investment bankers to take money that hardworking Americans have deposited and use that money on Wall Street, make a profit and keep it. Would you explain, please?
Well, the Volcker Rule is really designed to try and separate out different kinds of risk in the financial system. So prop trading, short-term trading contributed to some of the problems that the largest firms had, and therefore when they failed, the American people are the ones who ended up suffering from that failure. So that reform, along with other structural reforms, is designed to make it less likely that families will get crushed.
And less likely that deposits that hardworking people place in banks will end up in the hands of an investment banker on Wall Street with a gamble that may or may not succeed. True?
Well, I think that it's a bigger reform than that. That is, it's designed to really push that risk all the way outside the bank holding company to really try and separate out the risk so families aren't crushed in the future if we have a huge crisis.
That's what the Volcker Rule did with Dodd-Frank, but that's being eliminated, true?
Correct.
Okay, quickly. I remember how bad it was when we were going through the crisis in 2008. It was such that banks would not lend to each other. The banks refused to lend to each other. We had to pass Dodd-Frank, and we still need it. I yield back.
Time of the gentleman has expired. The chair now recognizes the gentleman from North Carolina, Mr. Pittenger.
Thank you, Mr. Chairman. Thank you so much for hosting this very important hearing, one of many scores of hearings we've had with multiple individuals who have come to testify from the private sector as well as from the academic world, those who have had vast experience, and thank each of you for joining us today. Mr. Allison, I would make special note of my friend from North Carolina, a graduate of North Carolina.
Thank you.
If I recall, you graduated with high honors, and the notoriety of the academic institution is only matched by their prowess on the basketball field. So,
I agree.
You do agree, as well as your education at Duke. But you know, more important to me of that is the 38 years that you've had in the banking business, right there at BB&T, and to serve 20 years as the CEO for that institution. And as I have watched you from a close distance from Charlotte, a major financial center, those of us in Charlotte had the utmost respect for you as the quintessential banker, one who really understood the business, the one who understood the customer, one who valued the importance of good banking. I was a banker, served on a board, community bank for 10 years from the time we chartered until the time we sold the bank. Like you, we were favored with a disciplined approach. We knew our customer. And we had very low loan losses. You, of course, suffered through the 80s and the 90s with great success. You went through this last decade without a lost quarter. It is remarkable. And so what you bring to the table, to me, really far surpasses all the regulators and the bureaucrats, people, frankly, I think that have good intentions, who come with the right spirit of wanting to address a real problem. But we get down to the bottom line. We get down to the real world of banking. And for us, it was knowing your customer. And you knew your customer. I went in to see you on several occasions just to talk and learn from you during that period of time. But what I want to ask you today is the impact of what's happened as a result of Dodd-Frank on the broader context of what's happened to that entrepreneur. What's happened to that small business guy who's trying to get started? What is the impact of that in terms of our economy in the future? Here we're tepidly moving along at 1.5%. This is the only period of time since World War II that we never could reach 3%. We have had an average of 3.5% for the last 100 years in this country of economic growth, and we're just barely moving along. Look at the future of where we are with our country and where that growth is going to come from and what's impeding that growth and how this plays a role into that. Kindly speak to that if you would.
Well, unquestionably, healthy banking systems lead to healthy economies. And community banking, even when it's done in a larger organization, is what spurs entrepreneurial activity, because we are basically small business venture capital lenders. And I saw this to concretize it. At BB&T, our board, once Dodd-Frank passed, we spent 9 or 10 hours a day on regulation and none on running our business. The regulators forced us to get rid of our community banking model. We were a very decentralized organization, which is one reason we went through the financial crisis without any losses. We had local decision-making with people that understood the markets. The regulators forced us to centralize our lending authorities just like the banks that failed. So they absolutely forced the model that hadn't worked because they were all academics and they knew all about mathematics. They just never made a loan. And they didn't understand what banks do, now, even larger banks that serve their communities. And the irony is the big banks have been the big winner. What I mean is the real big banks, a handful of Wall Street banks have been the big winner.
I've got a few seconds left. Give us a forecast of the future. What's going to happen if we don't fix this problem right now?
You're going to have a lot more consolidation in the industry, and basically community banking as a successful business is not going well. I keep hearing people say community banks are doing so well. Look at their stock prices.
What's going to be the impact on the economy if we don't help this entrepreneur?
I think we're going to be stuck in slow growth. I think if you don't have entrepreneurship, you don't have growth.
Thank you, sir. My time is
Time of the gentleman has expired. The chair now recognizes the gentlelady from Wisconsin, Ms. Moore, ranking member of our Monetary Policy and Trade Subcommittee.
Thank you so much, Mr. Chairman and ranking member, and I want to thank this distinguished panel. I'm the last member on our side here, so I apologize in advance for having you suffer through some of the inquiries along the same lines, but I do appreciate getting some clarification on some things. Mr. Wallison, you and I have talked before about your perspectives and about your views on your minority views with regard to the financial crisis and its causes. One of the comments that you have made, not only that the fault of this was Freddie and Fannie and CRA, but then you doubled down today to say that you had done research afterwards and found that your book, which I'll be happy to look at, bore all these things out. And you essentially blamed it on predatory borrowers. Now, I don't know about other people in this room, but I'm 66 as of last Tuesday, and I've only bought 2 homes in my entire life. And the only reason I have a second house is because I was a state senator and I didn't live in the district and I had to move when I won the state senate seat, sold that house to my daughter. So people don't go and sit down and buy a house every day. So it's amazing to me that you don't think credit default swaps or lax underwriting or CRA rating agencies are at fault, that you think it was predatory borrowers. But having said that, let me move on and just say that for one thing, Mr. Chairman, without objection, I'd like to enter into the record a letter from former Representative Barney Frank, former chairman of this committee, his letter to his constituents on the economic crisis.
Without objection.
Thank you. And one of the things that Barney Frank points out in his letter is that from like 1991 until 2006, when Democrats took over the majority, they were trying desperately to stop predatory lending. And that's what we have found, is that there's a lot of predatory lending that was involved. It was not predatory borrowers, it was predatory lending. I also heard you say that Freddie and Fannie underwrote bad loans. Freddie and Fannie do not underwrite loans. They were scammed as well. Mr. Barr, let me ask you something. This choice bill proposes to repeal Title I of Dodd-Frank, which governs the role of the clearinghouses. Can you talk to us about the systemic risk that may be involved if we were to pass this bill and to undo Title I, which deals with the clearinghouses?
The legislation would dismantle basically the process for overseeing designating financial market utilities, including derivatives clearinghouses, payment systems, settlement systems, basically the essential backbone of our economy. So it would remove the ability to impose heightened standards. It would remove the ability to provide liquidity in events of distress. And I think that would be a horrible mistake. It's consistent with the mistake that's made in the other part of the bill that repeals the authority to designate shadow banking firms like Lehman Brothers and AIG.
And what the impact, I got 1 minute left, so.
It will crush the economy.
It'll be like when Henry Paulson showed up that day and said, give me $700 billion. I don't want to go through that again. All right, so Title I will be eliminated under this legislation. If we don't have the Volcker rule, this will allow federally backed funds to trade, and it would create some sort of moral hazard. Do you agree with that? If we were to eliminate the Volcker rule, there's been discussion of that earlier. Some clarification about what is proprietary trading and what is market making. I agree we need to hone in on that distinction. But do you think eliminating the Volcker rule is a good idea?
I think that would be a mistake. I agree with you that clarification of the lines, what's clearly in, what's clearly out, gray areas might be handled with capital rules. So I think there's ways of implementing the Volcker rule more efficiently, but I would not eliminate it by any stretch.
And by the way, 85% of all these non-conforming loans were done by non-CRA and non-FDIC insured banks. Thank you.
Time of the gentlelady has expired. For what purpose does the ranking member seek recognition?
Mr. Chairman, I seek unanimous consent to enter into the record 108 letters from groups opposing all or part of the Choice Act.
Without objection. Chair now recognizes the gentleman from Pennsylvania, Mr. Rothfuss, for 5 minutes.
Thank you, Mr. Chairman. I thank the panel for helping us today understand these various issues. My first questions are going to go to Mr. Wallison and Mr. Pollack. As you know, under Section 165 of the Dodd-Frank Act, firms that are subject to the Fed's heightened prudential provisions are required to prepare and submit resolution plans or living wills that demonstrate how they can be resolved under the bankruptcy code without posing a risk to U.S. financial stability. Dodd-Frank authorizes the Fed and the FDIC to restrict the business activities of a firm submitting a living will if the firm cannot demonstrate that it can be resolved in a safe and orderly manner under the bankruptcy code. If necessary, the Fed and the FDIC, after consulting with the FSOC, may even order a firm to divest assets or operations. Mr. Wallison, your colleague Paul Kipiak has pointed out that the living will process outlined in Section 165 of the Dodd-Frank Act is a recipe for government command and control of private enterprise. He writes, quote, "Living wills are a gateway for regulators to change the company itself. If companies' living wills are not to regulators' liking, regulators can require the institutions to restructure, raise capital, reduce leverage, divest, or downsize. Thus, rejecting a living will gives regulators an opening to restructure the companies themselves. This type of regulatory discretion is not uncommon in the world, but is usually found in banana republics and countries where the government runs the banking system. Such unconstrained authority opens up all sorts of avenues for partiality and government intrusion into a financial institution's operations." Mr. Wallison, do you share Mr. Kupiak's concern that the vast discretion granted to federal regulators under Dodd-Frank's living will regime is essentially a license for those regulators to decide the proper size, scale, and business model of private sector enterprises?
Yes, it seems pretty clear that the legislation allows regulators to permit or to stop certain kinds of activities by companies that would otherwise be helpful to the market and perfectly legal. So yes, this is a major impairment of the freedom of companies to try to develop markets and serve those markets.
Well, is this setup consistent with your view of how a free market economy should operate?
It's completely inconsistent with how the market should operate, and that's one of the reasons why I oppose it.
Mr. Pollack, do you agree with Mr. Wallison's assessment? If so, will the Financial Choice Act provide benefits to firms and the market?
Yes, I do agree with him and with Mr. Kupiak. I think a theme of the Dodd-Frank Act is granting wide, unfettered discretion to regulatory agencies outside of notice and comment rulemaking to impose judgment and subjective views. The living wills are a great example of that. The stress tests, if I may say so, are another example where you can regulate through this regulatory proceeding without rules and without laws.
Previously, Senator Phil Gramm, Mr. Pollack, testified before this committee that the Fed and the FDIC have almost total discretion in deciding whether a plan is acceptable. Are you aware of any other industry in the nation that is subject to such requirements and micromanagement by the federal government?
I am not.
I'm glad my colleague from Wisconsin mentioned the former chairman, Mr. Frank. Mr. Wallison, do you recall a time in maybe 2003 when Barney Frank said he wanted to roll the dice on the housing market?
Yes, I do very well.
Do you know if he was ever held accountable? Did anything in Dodd-Frank ever hold him accountable or anybody who wanted to roll the dice in the housing market?
No, I'm afraid that was not done.
Dr. Michelle, I was at a Women in Business lunch last week in Pittsburgh where most of the attendees were small business owners, executives, and entrepreneurs. Much of the discussion centered on the difficulties that many women face in pursuing their goals, and we had a great discussion about regulations in Washington. At one point, one of the attendees stood up and suggested that regulations were not a problem and challenged those in attendance to identify specific regulations that hurt their businesses. Immediately, a woman jumped on that opportunity, and she said she was an executive with a community bank in the area. She told us that regulatory burdens for her firm were over the top in every respect. Thanks to the CFPB and its mortgage disclosure rules, it now took her customers twice as long to close on a home, 6 weeks to 12 weeks. Disclosure documents had also nearly tripled in length, leading to increased cost and customer confusion. How do the reforms in the Financial Choice Act provide consumers relative to the CFPB with the protections they deserve while supporting the growth of a vibrant financial sector?
Very brief answer, please.
Okay. Very brief.
If a brief answer is not possible,
we'll follow up with you.
I'm sorry. Yeah,
we'll follow up.
Thank you.
The chair wishes to advise all members and our panel that we expect floor votes somewhere in the next 15 minutes. Shortly thereafter, we will recess. I believe 2 votes will be pending on the floor at that time, so we will recess for approximately 30 to 40 minutes, at which time our panel can obviously take a needed break at that time. The chair now recognizes the gentleman from Washington, Mr. Heck, for 5 minutes.
Thank you, Mr. Chairman, very much. So from where I sit, I thought that the Great Recession, the global financial crisis, was the worst financial crash or panic, certainly of my lifetime, not having lived through the Great Depression. It obviously came, I think we would all acknowledge, as a surprise to a lot of bankers and regulators. And as a consequence, it caused a lot of people to do some serious introspection and reevaluation of their thinking, most notably including in 2008, the chair or former chair of the Federal Reserve, Alan Greenspan, who testified before the House and made the following statement: I made a mistake. I made a mistake in presuming that the self-interest of organizations, specifically banks and others, were such that they were best capable of protecting their own shareholders and their equity in their firms. More recently than 2008, he said, I've come around to the view that there is something more systematic about the way people behave irrationally, especially during periods of extreme economic distress, than I had previously contemplated. Those are obviously big statements and big changes from the vantage point of Chairman Greenspan, who had previously believed, as we all know, that regulators should absolutely defer to markets, which were made up, he thought at the time, of rational, self-interested actors. So I've read all your testimony today, and frankly, I wish there was more discussion of the lessons learned from the financial crisis and the Great Recession, because I think it's really important that we not go through that again, not have all that net worth wiped out, not have all that unemployment created. So I'm going to ask each of you, beginning with Mr. Allison, very, very briefly, if I may, to follow the model of Chairman Greenspan very succinctly and tell me what you learned from the financial crisis that conflicted with your earlier beliefs.
Mike, we need the mic.
Mike?
I learned that government policy, even well-intended, can be incredibly destructive. Affordable housing, which was really subprime lending, had a very positive thoughts behind it, and it was incredibly destructive and driven by government policy, including by Alan Greenspan, by the way.
Thank you, Mr. Allison. Banks played no role in lending money to people who shouldn't have been.
Banks made mistakes, too.
They're not government. Banks weren't government. They loaned money to people that they shouldn't have.
They were regulated.
I call it the fog of mirror test.
They were
Ms.
regulated.
I learned that when you put institutions into a system where a lot of their decisions are being driven by regulation, they often behave differently than you would expect a self-interested institution to behave.
They made me do it. Dr. Cook.
I believe that the monetary authorities should have as much flexibility, as many tools as they can to fight the next financial crisis, and they don't need to be micromanaged.
Mr. Pollack.
Having for decades studied financial cycles, Congressman, I learned that this cycle was like the others, severe, but there have been other severe cycles, and I agree that mistakes are key. Mr. Greenspan made an incredible mistake in deciding to set off a housing boom in the early 2000s. That's part of the government's responsibility.
And the private sector played no role in that. I'm always amazed, I have to interrupt and say, I'm always amazed that there are ideological points of view that seek to attribute and allocate 100% of the culpability to the three parties to this. It amazes me. Did the government not catch this, not intervene? Yes. Did the private sector in the form of the banks loan money to people that they should not have? Yes. Did people seek loans that they could not support? Yes. There's plenty of blame to go around, and I just have to say that when we refuse to acknowledge that there is lots of culpability to go around here, it frankly impedes our progress in preventing it again. Mr. Barr.
I agree with the last statement you just made. I mean, what I was going to say is that I think all the gatekeepers and safeguards in the system broke. So all of our private sector safeguards broke down, the capital provision broke down, lawyers didn't do their jobs, credit rating agencies didn't do their jobs, supervisors didn't do their jobs, bankers didn't do their jobs, borrowers didn't do their jobs. We had just a disastrous consequence when all of that broke down.
Thank you. I don't have enough time left for the two of you, and I apologize. But I'm going to ask one quick question, ask you to raise your hands. Raise your hand if you think that the problem of the last 10 years is too much investigation of financial crimes and abuses. Who thinks there's too much investigation of financial crimes and abuses? Thank you, Mr. Chair. I yield back the balance.
Gentleman's time has expired. The chair recognizes the gentleman from Colorado, Mr. Tipton, for 5 minutes.
Thank you, Mr. Chairman. Thank the panel for taking the time to be here. Mr. Allison, listening to you, thought it was really interesting. You were talking about CEOs of banks now being compliance officers, not being able to actually do the business that they want to be able to loan to the communities. And you're in North Carolina, is
Yes,
that correct? You know, I have a couple of comments out of Colorado, small community banks out of Colorado. One stated to me, we've shut down the majority of our mortgage group from 15 to 4 people because the business model no longer made sense. People lost jobs because the cost of the regulatory burden was too much. Another gentleman, banker in Durango, Colorado, stated, we want to be able to have the ability to be flexible with products and dealing with customers. But because of Dodd-Frank, it's not how can we help the customer, it's now a matter of how can we not get in trouble with compliance. In terms of dealing with our small community banks, do you think it would be important for us to be able to actually tailor rules and regulations to be able to meet those needs of the small community banks rather than the one-size-fits-all mentality of Dodd-Frank?
I absolutely do, and I think you have to take away the structure that's there, or the community banks are going to get stuck with the big bank regulations.
Well, when we're going down that road of actually sculpting it, we'd had Chair Yellen, and she kept talking about the trickle-down effect. So there seems to be unanimous opinion that our small community banks are really being bound by Dodd-Frank's action. Under Section 546 of the Choice Act, includes my bill, the Taylor Act, and this legislation would require that financial regulators examine the unintended effect of necessarily burdensome compliance requirements. Do you believe that this would achieve a more balanced approach to right-size regulatory framework?
I think it would be very helpful.
Good. Mr. Pollack, thought it was interesting listening to some of the comments that we've had in regards to the impact of regulators and in terms of policy that's going through. Is there anything that was required in Dodd-Frank when it came to actually doing a cost-benefit analysis in terms of how rules and regulations were put into place and how it would impact?
I don't believe so, Congressman, and it's certainly not a theme of Dodd-Frank, but it is a theme of the Choice Act, I think a very good one. It's fundamentally important that things be looked at as benefits and costs. Even if there's quite a bit of uncertainty, confronting the uncertainty is extremely important.
Right. You know, we often hear from some of our friends that really being able to have a cost-benefit analysis is just a tactic to be able to put the brakes on regulators. Do you see it that way?
I see it as a logical requirement for rational action, Congressman.
Right. Ms. Walson, do you have any comments on that?
No, I think that's exactly, I agree completely, as usual, with Mr. Pollack's position on these things.
Okay. Mr. Pollack, then, I'll go to you again. In the absence of an explicit statutory requirement, having financial regulators conduct an economic analysis and a retrospective review of their regulations, would that be an important thing to do?
I think it's a great idea, which is in the Choice Act, Congressman, and we all ought to be doing that. We were talking a minute ago of reviewing our mistakes, and we should review our past actions for what was right and what was wrong, and if it was wrong, that gives us a chance to fix it.
Right. And just to go back to you, Mr. Allison, a little bit more on the community banks, listening to some of the questions from our Democrat colleagues. Regulatorily, were banks put in a position If they did not make a loan, they were going to be in violation. And if they did not make the loan, they were going to be in violation. Did you find experiences like that?
Absolutely. There was tremendous pressure to do subprime lending. Yes, some banks got greedy and made mistakes. Ironically, those were the banks that were saved, like Citigroup in my view, and they were big banks. And that was a mistake, because what that does is encourage those banks to continue. They should be allowed to fail. I think the Choice Act would be much more effective at dealing with bank failures. And I do not agree with the systematic risk. Citigroup could have gone broke and BB&T had been happy. It'd been a good day. So they've been saved 3 times. That's how we got too big to fail banks. And the community banks always get hit with penalties because the really big banks do bad things and get bailed out.
Great. Thank you. My time's expired, Mr. Chairman.
The chair would like to advise the committee that votes have been called. We intend to go through 2 more sets of questions. Right now we have Mr. Williams and Mr. Poliquin on deck. We'll be taking a brief recess then to finish up the votes, and I recognize the gentleman from Texas, Mr.
Thank you, Mr. Chairman. And one could argue...
Will the gentleman suspend? For what purpose does the ranking member seek recognition?
Mr. Chairman, pursuant to Clause 2J1 of Rule 11 and Clause D5 of Rule 3 of the rules of this committee, I'm submitting for your consideration a letter signed by all of the Democrats of the Financial Services Committee notifying you of our intent to hold a Democratic hearing, also known as a Minority Day hearing, on the Financial Choice Act before a committee vote on this measure. I look forward to working with you to determine the date, time, and location of such a hearing.
The demand being properly supported, the continued hearing day will be scheduled with the concurrence of the ranking member, and members will receive notice once the day is scheduled. The chair recognizes the gentleman from Texas, Mr. Williams, for 5 minutes.
Thank you, Mr. Chairman. I guess with what we've heard today, that with this testimony, the Consumer Financial Protection Bureau is one of the most unacceptable and most unaccountable agencies in the history of the United States. So what happens when you create an agency that is not only unaccountable to Congress, but unaccountable to the American taxpayer? Well, let me give you a few examples. First, you get an agency that uses strong-arm tactics to coerce payments or settlements, often using faulty studies to justify enforcement. That is what happened to Ally and others who found themselves in the crosshairs of the CFPB. Second, you have an agency that is growing by leaps and bounds with no end in sight. According to the CFPB's own strategic plan, the fiscal year budget estimate for 2017 is $636 million, a 5% increase from last year. Third, you get rules that are thousands of pages. The proposed rule on payday lending is 1,341 pages, not to be outdone by the rule on prepaid accounts, totaling 1,689 pages long. And finally, you have an agency that hides behind their consumer complaint database. Although the CFPB received just 0.06% of their overall complaints on the above-mentioned prepaid cards, the Bureau ignored more than 5,000 public comments in this book right here. Okay, they ignored that, expressing support for these products, and issued the rule anyways, all at the expense of the consumer. So this is what Dodd-Frank gave us, Mr. Chairman, and that is why it is so important to fix this disastrous law. Now, Dr. Michelle, let me begin with you. As we've talked about, the very structure of the CFPB rule was unconstitutional late last year. The court rules in order to bring the agency within constitutional bounds, the president must be able to remove the director at will. Do you agree with the D.C. Circuit opinion that the lack of accountability Dodd-Frank provided the CFPB was so great that it violated the separation of powers embedded in the Constitution?
Yes, I agree. The PHH case is a great example. You have a director who can't be removed, who decided on which case he wanted to enforce, which company he wanted to go after, decided which statutes did and didn't apply, decided that it would be in an ALJ proceeding, decided that he didn't like the ruling, decided he could double the fine,
okay.
All of these things.
All right, another question. Would making the agency's director removable at will by the president provide accountability to the agency?
That would be an improvement, yes.
All right. Again, Dr. Michelle, the FTC has been enforcing consumer protection for decades, before the CFPB existed without ever conducting supervision. Isn't that right?
Correct.
Okay. Do you believe that the FTC has been effective in protecting consumers through enforcement actions without supervision power?
Yes.
Okay. And do you believe the CFPB would be effective at protecting consumers as civil enforcement agency that has investigative and enforcement authority rather than supervisory authority?
Yes, especially when it comes to the banking industry. They don't need any more supervisors.
Thank you. Would you comment on that, Mr. Wallison?
Yes, I agree that they don't need any more supervisors. Every agency of the executive branch ought to be accountable to the president. Otherwise, our elections mean nothing. You elect a president, and if Congress has the power to say this person cannot be removed from office, they are saying the election of the president had no account. It did not make that person accountable in any way. So this is what is at stake in the CFPB case.
And just in closing, Mr. Allison, I mean, when the public hears people in your industry, and even in my industry, I'm a car dealer, when they hear you say that since this legislation you've literally had to hire more compliance officers and loan officers, that's a true statement, isn't it?
Absolutely, absolutely.
And who's affected by that?
The consumer. Consumer always pays.
Right. I yield my time back, Mr. Chairman. Thank you very much.
Gentleman yields. The chair recognizes a gentleman from Maine, Mr. Poliquin, for 5 minutes.
Thank you, Mr. Chairman. Appreciate it. Thank you, everyone, for being here today. I represent some of the hardest working, most honest people in America up in Maine's 2nd District. Maine is vacation land. Now, if you folks have not planned your vacation to Maine, it is a good time to consider that because we are booking up quickly, and we have staff here to help anybody else if they need that help. Mr. Allison, we have about 500 small towns in our state. And in these small towns, you often have a community bank, a credit union, maybe a local insurance agency or a retirement fund manager. And these folks, these little institutions, are the pillars of our community. I love to travel around our district. I'm a business professional like you folks. This is not my profession in politics. I'm here to help, but I love to talk to folks that grow our economy and create jobs. I love to do it. And without exception, Mr. Allison, they tell me what Mr. Williams and Mr. Tipton have already talked about, which is their major problem is this compliance and this paperwork. They're spending more time filling out paperwork than they are selling money.
Absolutely.
I remember a conversation I had with a loan officer up at the Machias Savings Bank way down east in Maine, right before you hit Canada, you take a left right down there, and they're saying this is just driving up the cost of the business that we have, and they can't get the money out they need to families that want to grow and businesses that want to grow and hire. So my question to you, Mr. Allison, is, in your opinion, you have 30 years experience in the banking business. Does this Choice Act help with that problem such that small community banks and credit unions and what have you are going to be relieved with some of this burden of compliance and instead get in the business of lending money to our families?
Absolutely. I think the Choice Act would be very beneficial in that regard.
We have roughly 26 small community banks in Maine, and they're traditional. They take in deposits, Mr. Allison, and they provide checking accounts and savings accounts. They lend out money. They do not package these mortgages and sell them in the secondary market. Bangor Savings Bank and the Community Credit Union in Lewiston, they did not cause this recession. Don't you think it's a good idea to make sure, to back up what Mr. Tipton said, that the regulations, the rules that these bureaucrats in Washington come up are tailored to specifically the size and type of institution, the complexity of institution, instead of otherwise?
Absolutely, and it's ironic that the Dodd-Frank was supposed to penalize the very large banks, the Wall Street banks, and it's actually helped them, and it's actually hurt the community banks, which did not cause this crisis.
Great. We are batting 1,000. Let me ask you another question, sir. FSOC currently continues to deliberate on whether or not non-bank financial institutions should be designated as too big to fail and therefore come under a whole other set of regulations and rules that drive up costs, reduce product offerings, and so forth and so on. Now, if you and I are in the investment management business, we run pension management, retirement assets, and I hate to say this, your performance is lackluster, mine is good. Your clients are going to leave you and come to me. But guess what? The assets are held by Roger down the street in a custodial bank. So if you get into trouble, or I get into trouble, but the assets are held here, does that represent a systemic risk to our economy?
Absolutely not.
Of course it doesn't. Of course it doesn't. What advice would you give this committee when it comes to FSOC's ability to designate those non-bank financial institutions that represent no systemic risk to our economy? What advice would you give them with respect to the Choice Act?
I absolutely don't think that they ought to be able to designate them. I think also those companies ought to be allowed to fail if they get in trouble. That's good.
Which brings me to my next point and my last point. The Choice Act ends the requirement for taxpayers to bail out big Wall Street banks if they take too much risk and get into trouble. I happen to think that's a great thing. Now, we have a bankruptcy code that deals with this. Do you think that code, the existing laws we have now, could handle this problem?
I think we need some modification to the bankruptcy code, but I think the bankruptcy code would be much better than what's been proposed in the Dodd-Frank law.
Okay, and does the Choice Act accommodate that end?
Yes.
Thank you, Mr. Allison, very much. Mr. Chairman, I yield back my time. Don't forget the trip to Maine this summer.
Gentleman yields back. Votes have been called. This is a two-vote series. The committee will reconvene immediately after this vote series. The committee stands in recess.
The committee will come to order. The chair now recognizes the gentlelady from Utah, Ms. Love, for 5 minutes.
Thank you. Thank you, Mr. Chairman, and thank you for all of our members who are here, or our witnesses who are here for this hearing. I really appreciate it. I want to start off with Mr. Wallison. You may have noticed a slide being displayed over the course of this hearing that cites the Federal Reserve's data indicating that commercial and industrial loans are up 75% since Dodd-Frank became law. The graph represents trends for loans and leases in bank credits for all commercial banks through December 2016. So in your opinion, in your experience, do you think that that figure is entirely accurate?
No, actually, I don't understand that.
Okay, so in what ways do you think that there's room for nuances in explaining that trend?
Well, for one thing, all the data that we have seen shows that the banks have not yet reached the point where they were in 2008. The banking system as a whole, except for the very largest banks that are doing quite well. But in terms of return on equity and return on assets, they're still below where they were in 2008. In addition, and this is the most devastating fact about this whole situation, and that is there were 25 new banks in 2009. There were 9 in 2010. There were 3 in 2011. And since then, there has been either 0 or 1 in all the subsequent years. Now, what does that say? That says that the banks cannot make a profit. Otherwise, people would be forming new banks. So we have a serious problem here with this legislation. We have to get this out, and we have to start relieving the pressure on our community banks.
Do you have that graph that we can pull up? Does staff have that other graph that we pulled up where we separated large banks and small banks? Go back. There we go, right there. So before, can you look at the one before Dodd-Frank, please? When we took the data and we separated between large banks and small banks, the data before showed that small banks, you can see the difference between small banks and large banks.
Yep.
Now look at the data after.
Yes.
Which tells me that large banks are doing okay, and small banks are the ones that are providing less access to credit for those who need it in their communities.
That's right. In my prepared statement, I have a couple of different charts with lines on them, but show exactly that, and that is that the loans from the large banks have been going up, and the loans from the small banks have been going down. Large loans have been going up, and small loans have been going down, all consistent completely with the idea that the small banks are gradually going out of business because of the regulation, and the large banks are taking up whatever new business there is.
Okay, so I'm being as fair as I possibly can here. Who are the people that small banks lend to versus the people that large banks lend to?
Well, the large banks are not lending to the very smallest businesses. They are lending to the larger small businesses. But the really troublesome part is the startups, because in our economy, fortunately, and this has always been true, everything starts from the bottom. And the little companies that develop over time are the ones that eventually become the big companies and displace, in many cases, the big companies. The startups are the most in trouble now because the smaller banks lend to the startups, but they make what would be called character loans. They're making it to people who they know in the community. And those loans are not being made anymore because the bank examiners are stopping them from doing it.
Let me tell you the people that I represent who are actually getting less access to credit because of the burdensome regulations that are being imposed on our small bank communities. Now, people may say that this is not really about small banks and large banks, and we're not really here to help the small banks, but I'm telling you right now, when you get Jennifer Jones, who can't get a loan from her small bank in her community to expand her school, that affects middle to lower income families. When you get Brett Madsen in Sanpete County, who has a turkey farm that can't get access to the credit that he needs in order to get the tools that he needs to farm his turkeys, that affects the people in his community. Goldman Sachs is not in Sanpete County. You know, JP Morgan Chase is not in Saratoga Springs. And all of the banks that give them access to credit are closing their doors every day.
Time in the gentlelady has expired. The chair now recognizes the gentleman from Arkansas, Mr. Hill.
Thank the chairman. Thank you for holding this hearing. I was particularly pleased about the Choice Act, that it really has one of the first innovative proposals that we've seen in the regulatory system in terms of ideas in some time. And I want to thank Mr. Allison and certainly my friend Tom Honig at the FDIC for being the inspiration behind it. And that's this off-ramp provision for banks that hold Tier 1 capital at 10%, Tier 1 leverage ratio of 10%. I was looking at all the banks at the end of the year in Arkansas, and 3/4 of our community banks, we have 103 community banks in Arkansas, 3/4 of them meet that 10% leverage ratio. There are several others that are quite close, and the median ratio for the state was 11.16 in Tier 1 leverage ratio. So I really do think that this is an important step to reward high capital with more modest footprint of complexity in how we do prudential regulation. Mr. Allison, have you been able to identify, sort of in your own thinking about this, because you've done a lot of thinking on this point, do you like the 10% leverage ratio number that we've selected? Do you think that that sort of represents a sweet spot between capitalization and financial stability while at the same time facilitating bank continued growth and profitability?
I do. I think it's a reasonable number. It's defining that number is part art and part science.
Yep.
But the important thing is you've got to have a fair trade-off. Because what Dodd-Frank asks is for banks to have a lot of capital and a lot of regulation, and they can't stay in business. And the regulators have chose more regulation because they like to regulate, right? It's their job. I think we'd be much better off with more capital and less regulation. So that's what makes it work economically.
I'm really reminded, knowing of your past CEO-ship of BB&T, I'm really reminded of Jim Grant's quote last year in his newsletter where he said, because of Chair Yellen's desire to have macro-prudential regulation, Grant postulated there's just no rule for micro-prudentialism. That is what CEOs and boards of directors are supposed to do. And he said, do you think there'd be any difference in outcome if all of the management of the bank didn't show up one day and just the regulators were there? So
I think all the banks would fail fairly quickly,
yeah.
in my opinion.
Thank you for that. If I could turn to Ms. Pierce, I want to switch gears from capital formation to the ideas of capital formation for another challenge that we've tried to address in this bill, which is a loss of our public companies. We've about 50% of our public companies we've lost. This means there are fewer opportunities for people's 401k plans, fewer opportunities for individual investors to participate in economic growth. And one of those barriers is this regulatory cost of being public. And one of those issues is the burden of the governance process and access to the proxy. Do you think that the current $2,000 ownership threshold for submitting a shareholder proposal is still in today's age a reasonable threshold? And also on the holding period, is a one-year holding period a requirement for submitting that proposal reasonable?
Yeah, I mean, I think it's time to revisit those thresholds only because shareholder proposals have become very costly to companies and to the SEC in processing them. And so it seems to make sense to take a look. Shareholders obviously pay every time a company has to respond. So we need to look again and see what reasonable thresholds would be.
Thank you. Mr. Wallison, one thing I've heard from regulators off the record and from bankers of all sizes, community banks and then large complex institutions, is the issue that the Volcker rule, no matter how well intended, just isn't working. What are your thoughts about the burdens to institutions of all sizes, and is that rule, you think, miscorrected?
The Volcker rule is a really serious problem, and first of all, it applies to much more than just insured banks. It applies to all all firms affiliated with banks in any way. So they are all covered by these restrictions. The trouble is it not only affects their ability to buy and sell securities as market makers, it also affects hedging. The banks have to do hedging in order to protect themselves against losses on the various things that they are invested in. And unless they can show that the hedge is actually related to something they've invested in, they're in danger of being charged with proprietary trading in order to put the hedge on, because the hedge means they bought some kind of security for their own account, which sounds like proprietary trading. So the banks are likely to become much more risky, even the largest banks, as well as the medium-sized and small ones, when they try to comply with it.
Time of the gentleman has expired.
Thank you,
The
Chairman.
chair now recognizes the gentleman from Minnesota, Mr. Emmer.
Thank you, Mr. Chair, and I want to thank you for holding this hearing. Earlier today, it was suggested that it's wonderful that this is regular order, but we hope we're going to have more than one hearing on this. It ignores the fact that many of the concepts that are in the choice proposal have been debated and discussed now for years. And to Representative Love's point when she had those graphs put back up on the screen, if we think back to 2008, there were roughly 8,000 community banks in this country and roughly 8,000 credit unions. A year after the crash, there were roughly 8,000 community banks and roughly 8,000 credit unions. They did not cause the crash. And yet here we are a little more than 6 years after Dodd-Frank was passed, and we're down to about 6,000 of each, and we're not growing at all. It's pretty clear that Dodd-Frank has been a problem to the capital generator for the small businesses, as Mr. Wallison was talking about. Nobody, as I've heard today, is talking about some of the specific organizations created in Dodd-Frank, and I'd like to touch on one, maybe start with you, Mr. Wallison. The Financial Stability and Oversight Council, another one of these very interesting organizations that was created for a guy that's new to Congress, off the books. It's not under the appropriations process or the supervision of Congress. It works off the books. Mr. Barr states in his written testimony that when the FSOC, as it's known as in the alphabet soup of Washington, in making its SIFI determinations, it's established a system that, again, in Mr. Barr's words, quote, provides for a sound, deliberative process, protection of confidential and proprietary information, and meaningful and timely participation by affected firms, close quote. Mr. Wallison, do you agree with this assessment of the FSOC's process?
I'm afraid I can't agree with that. And we didn't know very much about the process until the MetLife case, when MetLife actually challenged its designation. And as they described what they were permitted to see, that the FSOC had as kind of evidence for their being designated, they were restricted from seeing a lot of the things that anyone who was in a normal kind of investigative situation like that would be permitted to see. So the FSOC is not only non-transparent for those of us outside, it's not even transparent for the people who are inside and being designated. So you cannot call this a fair process, and I'm afraid it's more like a star chamber than anything else.
Well, I'm glad you brought that up, because another one of the quotes has to do with, I think in his written testimony, Mr. Barr notes that members of the FSOC are not beholden to their agencies, but rather, quote, participate based on their individual expertise and their own assessments of the risks in the financial system, close quote. Very interesting when we talk about their expertise, that they express and are heard based on their expertise, especially when we look at the MetLife situation. Mm-hmm. When the guy with expertise in insurance was completely ignored within the star chamber, as you referred to it. I mean, is there really a deliberative process that goes on in the FSOC?
Well, there are two big problems. First of all, you might be an expert in securities, but you're the only securities expert who's sitting on it, and there are 3 bank experts sitting on the same organization. So the banks kind of have more votes than other parts of the financial system. The other part of this, so troubling to me and to anyone who is concerned about the Constitution, is that the people who are sitting on the FSOC board are all appointed by the same president. Ordinarily, in agencies that are commissions, you have a bipartisan arrangement, and so a commission, when it speaks, it's speaking on a bipartisan basis. But when you appoint only to the FSOC the person who is the chairman of that agency, that person probably was appointed by the president in power. And all of them are sitting around the table, and they're looking at one person, the chairman, who is the Secretary of the Treasury, and a very close person, very close advisor to the President of the United States. So when the Secretary says, this is what we should do, these people are not going to be exercising their individual abilities and skills. What they are going to be doing is simply following the direction that they're getting from the Secretary.
And it looks like I'm going to run out of time, but I was going to ask Ms. Pierce if putting them under the congressional supervision and appropriations process might not solve some of these problems, short of getting rid of it. But I see my time's expired, so I apologize.
Time of the gentleman has expired. The chair now recognizes the gentleman from New York, Mr. Zeldin.
Well, thank you, Mr. Chairman, and I appreciate your leadership on behalf of those hardworking constituents in the 1st Congressional District of New York on Long Island, trying to obtain a home loan for a new house or to obtain a car loan to be able to access free checking for that small business in my district trying to access more capital. I appreciate all the witnesses for being here today. My district, there are a lot of small business owners and entrepreneurs who have that next great product or idea and are struggling to access capital when it comes time to get their businesses off of the ground. These innovators are being forced out of state or worse, out of the country to find a more favorable regulatory climate. These firms are often pre-revenue, having just enough cash on hand to keep the lights on. So without access to private capital, growing a business and hiring is impossible. Most of these emerging firms are also pre-IPO and need to attract the ground-level investors that make going public and to grow, create more jobs possible. Unfortunately, major obstacles have been put in place by Dodd-Frank and other onerous laws and regulations that have made it harder for these entrepreneurs to hire, grow, and make money. Ms. Pierce, I'd like to start with you. What provisions in the Choice Act, and in particular Title IV, will most help small and emerging companies to grow and create jobs?
I mean, I think there are a number of provisions that will be helpful, including making it easier for venture capital funds and for angel investors to invest in small companies. I think that also once a company, when a company is looking for investors, it needs to look for accredited investors if it's a private company generally. And the bill would expand the types of people who can qualify as accredited investors, which is a much-needed change.
And Mr. Allison, would you like to add anything to that?
I think the biggest thing is the opt-out will allow community banks to go do what we did at BB&T, which is do venture capital lending for small businesses that are really too small for even the smallest end of the private market. And that's a very low-risk market long-term if you do it right. And we had thousands of success stories that created hundreds of thousands of jobs, and we can't do that anymore.
Well, I thank you both, and I appreciate your perspective. There was a comment that I wouldn't want made earlier. I wouldn't want anyone to take it, the wrong way, as if there aren't other economists on this panel with a broad breadth of experience capable of talking macroeconomics. Dr. Michel, what have been the macroeconomic impacts of the hundreds of new regulations imposed by Dodd-Frank?
So we estimated part of that with a standard sort of look at banking risk, or I should say banking costs, excess borrowing cost, and we came up with a 22 basis point increase since Dodd-Frank. We used that, a colleague of mine at Heritage and I used that, that's the we, and we used that in a standard macroeconomic approach to pull that excess borrowing cost back out of the economy, and it estimated around 1% increase per year in GDP. It had up to, I think, about a $340 billion dynamic revenue effect, It had a 3% per year average increase in the capital stock. And this is not a model that was designed to model Dodd-Frank. This is just a standard macro approach. So quite significant cost, quite significant impact.
Mr. Allison, you want to add anything to that?
Yeah, I don't have a concrete measurement, but there's no question that we've had less innovation. You can just look at the startup numbers for new business and the shift in employment where new businesses and small businesses are getting a smaller share of the economy. And a lot of jobs, unfortunately, in the big businesses are entry-level jobs. And so the shift has impacted the quality of jobs, not only the quantity of jobs, and the creation of innovative jobs.
Well, thank you, Mr. Allison. I'm going to yield the remainder of my time to Mr. Emmer to finish his question for Ms. Pierce.
Thank you. Ms. Pierce, so the question quite simply is, by putting something like the Financial Stability Oversight Council under the supervision of Congress and in the appropriations process, could we solve some of the issues?
Yeah, certainly appropriations will be helpful in making FSOC more accountable. Taking away its designation powers is also an important step.
Thank you very much. I yield back.
I yield back to the chair the remainder of my time.
Time of the gentleman has expired. The chair now recognizes the gentleman from Georgia, Mr. Loudermilk.
Well, thank you, Mr. Chairman, and thank everyone on the panel for being here and the opportunity that we have to correct what I believe was one of the greatest wrongs done to the economy and the American people. I want to talk a little bit about stress tests. Now, my doctor wanted to do a stress test, but he told me after the last couple of weeks dealing with health care legislation that if I'm still walking, I'm probably pretty good. Dealing with the stress test, the committee has had some testimony and hearings we've had here that often regulators are punishing banks for failing to meet requirements that are never stated. Mr. Allison, has the Fed lacked transparency around the stress test process?
The stress test, in theory, can be useful, but what's happened has been an incredible waste of resources around stress tests because they started out saying they wanted banks to come up with their own stress tests, and at the end of the day, they want everybody to have exactly the same stress test. And the irony of that is it increases risk because if everybody weights the same assets the same, you get systematic errors. And a concrete example of that's very recently in energy lending, which a few years ago was supposed to be low risk, and now it's high risk. And it encouraged more energy lending and actually increased risk. So the stress test, banks doing mathematical models is okay independently. When they're forced by regulators, they lead to bad outcomes. You can probably imagine that in medicine, the same kind of thing.
Well, I know that the Fed recently exempted most banks from a qualitative part of the CCAR stress test. Should we expand that to all banks?
I would say so, because the qualitative is totally a subjective judgment on the regulator's part, and they won't tell you what it is. I know at my company, they had to spend a whole bunch of money making the qualitative side better, even though the bank was ranked as one of the lowest risk banks in America.
Mr. Pollack, you...
I fully agree. I think the qualitative part, which is indeed purely subjective and political, should be eliminated.
Okay. Ironically, Fannie and Freddie both passed a stringent stress test right before they failed in September of 2008. Even former Chair Ben Bernanke stated it was difficult to predict future economic turmoil. Are the stress tests really a reliable tool for predicting future downturns? Or
I think not. I think they can be a tool if they're taken in context. But we've done a bunch of studies at Cato that show the more complex a model is, and these stress test models are very complex, the more likely it'll be wrong. Yeah. Rules of thumb, like debt service to income in the mortgage business, are much better than mathematical models, of which your stress tests are, because they get lost. The forest gets lost for all the trees.
Mr. Pollack?
Paul Kupiak of AEI did a study recently of stress tests showing that their outcomes were wildly inaccurate.
Okay. Thank you. Dr. Michelle, we'll talk about the CFPB and the massive amount of data that they've been collecting and the potential of cybersecurity risk. Now, I also serve on the Science, Space, and Technology Committee, and last Congress led some investigations into some cybersecurity breaches, and we had the Inspector General before one of our hearings, and I asked the Inspector General, this was after the OPM data breach if he would rate on an elementary school rating scale the federal government cybersecurity posture, and he said it was a D-. And the only reason he didn't give it an F is because of the minor changes that were made at the OPM after their breach. How concerned should we be with the mass collection of data with the CFPB, and what is our risk of exposure, not only just to bad players in this nation, but foreign entities?
Well, I'm not a cybersecurity expert by any stretch, but I mean, I'm concerned that they're collecting so much data, principally because I still don't really see exactly what they're doing with it. You have a lot of stuff that's being collected that's just sitting there in many respects with no clear purpose, as far as I can tell. You want me to elaborate just a second? If the payday lending stuff is a great example. You've got millions and millions of things in this database on all these people, and if you look at the number of complaints in payday lending, it amounts to about 0.1% of transactions in the industry. Yet, that has all been pushed aside. That would dictate to a rational person that maybe this isn't such a big problem. Instead, they come out with a rule and they openly say that this could kill off 85% of the industry. Those two things don't mesh at all. So I don't understand what is the purpose of collecting all that data.
Time of the gentleman has expired at this time. The chair wishes to thank Mr. Wallison for his testimony today, and Mr. Wallison, you are now excused from the panel. The chair now recognizes the gentleman from Ohio, Mr. Davidson.
Thank you, Mr. Chairman, and Mr. Wallison, thank you for being here. Thanks for the things that you've addressed with the FSB, and particularly the short changes they've done on American sovereignty. So that's of particular concern. I have enough questions for other folks, so thanks for being here. And really, thank you all. I've learned a lot and reaffirmed many things that I have already learned about the impact of Dodd-Frank, both from your testimony today and from your prior work, so thank you for Mr. Allison, in particular. I appreciate your clarity, both here in your books, in your work at Cato, and you all have sounded the alarm for some of the misses and perhaps unintended consequences of Dodd-Frank. While I have myriad concerns about the negative impact on families, farms, and businesses, I am particularly concerned about due process. These protections are some of the most important in our Bill of Rights. And Ms. Pierce, you've talked a fair bit about some of those concerns with respect to the SEC. Under Dodd-Frank, do respondents in SEC administrative proceedings have the same rights as defendants do in federal district court?
No, the two systems are different, and some have argued that there are some issues with the administrative proceedings and have called on the SEC to make changes. I don't think the SEC has made enough changes yet to equal out the two.
Does the mismatch create the potential for different legal interpretations of the same or similar laws and potentially create inconsistent enforcement outcomes?
It does. There's a potential that you could get different outcomes depending on which forum you were in.
Do you believe that a respondent can receive a fair outcome when the SEC serves as prosecutor, judge, jury, and many times ultimately the appellate body?
I think that the SEC can run its system well. I think it will run it better if people have the option of going to court if they prefer, which is what the Choice Act would allow.
Thank you for that. And I just wanted to open up to the panel just some of the concerns that you may have with respect to due process that you've seen as a consequence of the Dodd-Frank changes.
I think one general thing is that any regulated company, particularly now, really doesn't have practical access to the court system, because the time the courts decide, you're already out of business. And under the doctrine the court has, they think the regulator's right. You have to prove the regulator. It's like being assumed guilty and you have to prove you're innocent, and that is very hard to do.
This is fundamentally a consequence of Chevron doctrine.
Yes.
Yeah.
You know, a lot of the regulation is not even being done through rules that could be challenged in court. It's being done through supervision, which is it's a big problem in the bank regulation side.
I think if you look by contrast at the way in which the court system has actually gotten involved in Dodd-Frank compliance issues, it's been quite extensive. I mean, the fact of the matter is in the PHH against CFPB case, which is challenging its constitutionality, that is a case involving whether the CFPB followed proper procedure with respect to its internal operations, and the courts seem quite aggressive about enforcing that. I think you can see it in the MetLife case. You can see it in the cases brought against the SEC. So
I want to highlight that
they've
this
been
is
quite
pretty
active.
late in the game and fairly consequential. If you look at PHH, look at the valuation of their company and what happened to, they've been decimated basically by fiat.
I think if you look at the way in which the court system is overseeing
I would also-
these
I just-
agencies, it's
just-
been quite active.
Ms. Pierce, would you please?
So I would say that, it's fine to cite PHH and MetLife, but those are the two companies that were able to fight because they had the resources and the courage to do so. But often it's just not worth the regulatory risk to take the fight to court. So you just suffer with the consequences.
Thank
and
you for
never
pointing
get
that
to
out. I think
court.
we're at about a 90% conviction rate, which is, a little shocking. It basically says, cave or else. Dr. Michelle, you were going to say something.
I was just going to add ally to that equation. It's an example of just kind of giving up and going ahead. You have no reason. You have no contact with the borrower at all, and you're accused of racial discrimination, and you know that the race of the borrower was never even
Particularly when automotive lenders were explicitly excluded.
carved out, and you still find yourself with the choice of going to court or just settling to get this over with.
Thank you all. Mr. Chairman, I yield back.
Gentleman yields back. Chair now recognizes the gentleman from Tennessee, Mr. Kuskoff.
Thank you, Mr. Chairman, and thank you all for being here this afternoon and this morning. Since the enactment of Dodd-Frank almost 6-7 years ago, to me it's incredible that we have had very few new banking starts in this country. Mr. Allison, if I could, with your banking experience, can you talk from a practical and procedural standpoint today, if you wanted to start a new bank, which I can tell from the expression that you're not particularly interested in doing that, what are the real world hurdles and challenges that Dodd-Frank presents to somebody who would want to start a new bank today?
The biggest challenge is the regulators don't want you to start a bank. So they're going to come up with every obstacle they can dream of to start a bank. And then secondly, when you do your cost analysis and your profit analysis, you're going to say, I can't make any money because I'm going to have to hire an army of compliance people before I can make my first loan. So I'm going to be embedded with a cost structure radically higher than a traditional community bank startup has. And this is very interesting. The ability to sell your bank, it sounds like that will consolidate the industry, but actually it encourages startups. Because a lot of banks are built to run for 25 or 30 years, kind of the life expectancy of the board and the management, and then to be sold. So the fact we've made it hard for people to sell their banks, ironically, is not kept banks from being sold, it's kept banks from being started because that's the payback. I can't get a high enough return in the short term, but 10 or 15 or 20 years down, I'll be able to sell the bank, and that's kind of when my management talent's going to run out, and I'm not going to be able to hire enough people to replace me. Kind of mindset.
Well, I mean, the converse. Let's assume that we get the Choice Act passed in toto, the way that it's written now. Can you predict what that would do for new bank starts in this country?
I would predict a significant increase in the number of new bank starts. That's pretty radical, because all they got to meet is a 10% equity requirement, which is really not that hard, and then they will have the option in the future, if they do well, to sell it. And that's the kind of, the carrot out there. So I think you'll see a significant increase in the number of startups. And I think that'll be good for the economy.
Thank you, Mr. Allison. Dr. Michelle, you and I had the opportunity, I believe, to talk earlier at our subcommittee hearing. And I do want to ask you, if I could, about the CFPB for a moment and the consumer complaint database, if we could. The way I understand it, that when complaints are submitted to the database, we've seen that the facts are not verified. In other words, the complaints are submitted, there's no verification. So somebody could submit a complaint. It may be valid, maybe not valid, it may be partially valid. Can you, if you could, talk about how the CFPB could ensure the validity of these claims before they're submitted and placed in the public domain?
Sure, just find out what happened before you put it on the public database. The FTC has a similar model where those things are kept internally and they verify the complaints internally. And I mean, this isn't supposed to be about public shaming and finding out later, oh, we made a mistake. I mean, that's what purpose does that serve if we're talking about protecting people?
And following up on that, do you believe or have an opinion as to whether the CFPB should remove these complaints from the public domain rather than keep the database as
Sure.
is?
Yeah, no, I don't see any public purpose to having all of that raw complaint information public. It's counterproductive.
And how would the CFPB go about verifying these complaints once they're submitted?
Well, if we have a federal agency that is an enforcement agency and they're doing their job, when they receive a complaint, they check it out, they verify it, they talk to the person who filed the complaint, they talk to the company that the complaint is filed against, and they go and actually investigate what happened. I don't think anybody would have a problem with that.
Do you have any idea how many complaints have been submitted to the CFPB?
I have not looked lately. I know that it was millions at some point. I don't know. I could not give you a number now. No, I have not looked lately.
And again, none of those complaints have been verified. They are simply
But
submitted.
they were simply submitted raw complaint data, yeah. And I don't have the error rate off the top of my head either, but I know that they have made some statements about how many of those were not actually verified complaints.
Thank you, Dr. Michelle. I yield back my time.
Time of the gentleman has expired. The chair now recognizes the gentlelady from New York, Ms. Tinney.
Thank you, Mr. Chairman, and thank you, panel, for a great discussion. I come from a very rural area in central New York where we had wonderful old names of old community banks, Oneida National, the Savings Bank of Utica, Homestead Savings, Herkimer County Trust, Marine Midland Bank, which is a little bit larger bank. All of those have gone. We do have one solid community bank left called the Bank of Utica, and we have a regional bank called Adirondack Bank. But so many of these regulations have caused us to lose our banks. And in fact, there haven't been any new banks created, new de novo banks created in New York State since Dodd-Frank was passed. My concern as a small business owner who has relied on many of these great relationships, I know some of you mentioned character lending throughout the years, and honestly, I can go into my bank and hand my checkbook to the teller and go back and talk to the bank president who's in the same room. And I know that's a quaint situation that doesn't happen often. And these banks, some have been excluded from regulation, but many of them can't even compete in the big market because they don't have the compliance. And I think Ms. Peirce mentioned really significant, so many of them just either stop lending to their customers, force their customers into having second mortgages or putting themselves into credit cards to get financing because they don't want to face litigation, and it's so expensive. They can't afford the compliance costs. It's a very similar situation as it is for us as a small business owner in the area. I just thought what I'd like to do is talk to you about the ability of a regulator and for us to look at sort of Chevron that was referenced by my colleague with the expansion of the executive branch and how Dodd-Frank has caused over 400 different rules just to implement it and thousands of pages, or 2,300 pages or whatever it is, and how we can roll that back and come up with a way using economic factors to put some restraints on regulators. And I'd love to know if you could just comment on that. Maybe Mr. Michel will start first and we'll work with the panel, because to me, I think that's really where we're going with this. I mean, the regulations have proven to be so much burden for our
Well, I know this isn't on the table at the moment, but I'm not a fan of independent regulatory agencies at all. I think that's a problem. So, I mean, you're supposed to be accountable to the people who have been elected, and these should be more direct rules. They come directly from Congress, and there shouldn't be so much discretion, and that would be one way against that. Passing a law that gives the regulator a great deal of discretion to come up with a rule, and it ends up looking like something that was almost nothing like what was initially discussed, is incredibly poor policy. So, I mean, So not having those independent agencies with the ability to do that is a way around that. And I think with the Choice Act, if you can play around with the model that is here. You can have a much higher equity requirement with a much bigger regulatory relief component, and that way get away from doing some of these things.
Thank you. Mr. Pollack, do you have a comment on that?
Congressman, first I'd like to say on the small banks going down in number, which they obviously are, one of the reasons is there are few new banks being created. We ought to have as a policy at all times the encouragement of new capacity and new entrants, which we don't have, especially in times of trouble when you most need new entrants. The regulatory philosophy is to cut off new entrants. On the general question of more accountability in regulatory activity, it is essential, in my opinion, for the costs of the regulation and the effect, as we have been discussing, of the regulation to be explicitly taken into account and compared to whatever benefits we think there are. On mortgage loans, in particular, we've had very heavy regulatory and legal risks imposed, and the result is for little banks, I'm talking about less than $1 billion in assets, mortgage loans in those banks have been falling since 2011. And anybody who's tried to get a mortgage knows why. The regulations have made it extremely painful, even for quite good credits, to go through the process.
Yeah, thank you. I appreciate that. As a former bank attorney, I used to be able to do maybe 10, 15 residential closings a day. I probably could do 3 now just because of the burdensome paperwork. And again, I know Mr. Barr is anxious to answer, but I think I'm losing my time here. So I want to say thank you to the panel for really great work today. It's really an honor to have you here and talk about the Choice Act, and we're excited about getting it passed. Thank you.
The time of the gentlelady has expired. The chair now recognizes the gentleman from Indiana, Mr. Hollingsworth.
Hey, good afternoon. Thanks so much for being here. As she said, I really appreciate everybody's investment of time and all the great comments and conversation that we've had. There's been a lot of discussion throughout the course of the day about banks taking exceptional risks inside their trading book that has caused losses that have been covered by the taxpayer, and that's why we need the Volcker rule. Dr. Michel, would you care to comment on that and whether the true issue that caused the crisis was in the trading book or was it in the loan book of these?
I'd love to comment on that. Thank you. So first of all, this started off in the wholesale trading market, wholesale funding market. So this has nothing to do with the banks really in that sense at all. Secondly, if we're talking about risk, banks take risks every day, but commercial loans are risky. A portfolio of commercial loans is riskier than a portfolio of stocks. Right. This makes no sense at all. You have, prior to Dodd-Frank, you have the Fed, the FDIC, the OCC, with all the ability in the world to stop any of those large banks from trading, doing proprietary trading, doing any of the securities investment that they want. Right. Type 1 securities, Type 2 securities, Type 3, all these things are codified. This is the biggest nothing burger ever. This is this is just a waste of time, effort, energy, and money, period.
Excellent. Thank you. Thank you for that. One of the things I also wanted to talk about, Dr. Cook, you had mentioned earlier today and talked a little bit about, it gave a great stirring introduction about how this will never happen again and how we make sure that this will never happen again. I guess my question is, does Dodd-Frank slaughter the business cycle? Do we expect that we'll never have another downturn again now?
Excuse me, I didn't go that far.
I got to see macroeconomics, by the way.
Right.
You know something I don't.
Let me be clear. Yeah. Let me be clear. To try to stem the irresponsible practices that were happening before. But, I just want to be careful, as was stated in my prepared remarks, this is not perfect. Dodd-Frank is not perfect.
Well, I guess in that, I think what you were trying to get at was not that we've slaughtered the business cycle, but hopefully we can dampen the amplitude of the ups and downs. Is that kind of what you were trying to convey in your introduction?
No.
Okay.
No, still focused on financial practices. Now, we keep working as macroeconomists on trying to, and we thought we had it figured out before the recent crisis.
How do you determine what's irresponsible and what's responsible behavior? Who gets to determine that?
So and the Federal Reserve, all of the regulators can.
So regulators determine what's responsible and irresponsible lending. So this is really, Dodd-Frank is government pushing capital in certain directions and out of other directions and determining who should be the recipients of loans and who shouldn't be the recipients of loans. So government-directed capital is the answer to the crisis in your mind?
Oh, not at all.
Okay.
Not at all. No,
So
no,
more
no,
regulation is not
no.
more government direction of capital?
No, I want to be clear. When I say irresponsible, I don't mean it as, you're making it as a technical term. I want to make sure that I'm saying that this is, it's not, this isn't something that, a standard that you are looking at a banking law and saying this is responsible or these are the characteristics, these are the criteria for responsible and irresponsible banking. But I want to make sure that we understand that the crises, the recessions that are the deepest we know from economic research are the ones that are fueled by bad financial practices, by financial crises. That's what I don't want to see happen again. The Great Depression, this Great Recession, and what is happening in Europe. We certainly don't want that to happen again.
Right. I guess back to Dr. Michelle, I wanted to talk a little bit about Title VII and better understanding how Title VII might certainly under Dodd-Frank begin to change the way clearinghouses are structured and offer them with Title VIII some additional avenues. Could you talk a little bit about that?
On 7 with the clearing mandate, I would go back to this isn't quite as, maybe I don't have as strong feelings as I do on Volcker, but but this is another one. This is a really bad idea. If counterparties wanted to have these derivatives cleared and clearinghouses wanted to clear these things, that was already happening.
Right.
And that's a progressive thing over time.
Right.
As those things become more standardized and more accepted, that's what happens. To mandate it is a very bad idea, and then we end up concentrating all the risk in the clearinghouses, and then we go to Title VIII and say, here, you have a direct line to the Fed.
So we've basically just opened another avenue towards more bailouts and more opportunities for bailouts through Dodd-Frank.
Absolutely.
Instead of how it was sold originally.
Absolutely.
Thank you. I appreciate the time, and I appreciate all of you being involved today.
Time of the gentleman has expired. The chair now recognizes the gentleman from New Jersey, Mr. Gottheimer.
Thank you, Mr. Chairman, and thank you to the panel for being here today. If I could start with you, Mr. Allison. With the benefit of almost 7 years of experience now, we can all identify areas where Dodd-Frank could be improved without compromising the core regulatory framework that has been put in place. One such area for potential improvement is Section 619 of Dodd-Frank that inhibited speculative investments. Former Fed Governor Tarullo highlighted this in his departing remarks earlier in April. What do you think of his assessment, and what are some of the tweaks that can be made to keep our regulations smart, but also keep our regulators adequately focused on protecting the safety and soundness of the banks and consumers?
I think you have to look at a bank at a meta level, not at the parts. And regulators, and Tarullo in particular, likes to look at the parts, and I think that's a poor way to do it. So if you look at the Canadian banking system, their regulators evaluate the whole organization, and they've had much smaller, lower failure rates than we have. And I think our kind of regulation tends to focus on these little parts and add them together instead of asking the macro question, including the basic philosophy of the bank. Is it a high risk taker or not?
Thank you very much. I appreciate that. Related to that, Section 619 requires that 5 regulatory agencies examine traders' intent to effectuate the rule's prohibitions. Is that inherently difficult for regulators and the banks?
I would say probably so. I don't think they have the skill set to do it, would be my view.
Okay, thank you very much. Mr. Barr, if it's okay to ask you a question. Do you think the OCC's failure to address sufficiently Wells Fargo bad sales practices more than a decade ago shows that the agency may have been putting its consumer protection mission in a subordinate role to its other mission of improving the profitability of the bank?
Well, I do think that the failure was rather significant, and it was one of the reasons that the basic problem of the lack of prudential agencies' attention to consumer issues was one of the main reasons for bringing those authorities together under the new Consumer Financial Protection Bureau. And I think the recent report on Wells Fargo reinforces that it was a good idea to bring those authorities together under the CFPB to give it the power to protect American families and to really have as a core mission and a set of expertise protection of consumers. So I think it reinforces the choice made in Dodd-Frank. And frankly, undermines the choice made in the Choice Act.
Right, so you would say, in that, with what happened with the fake account scandal, that's what the mission of the CFPB sort of, it meets its mission in that case.
Yeah, I do think you want a consumer agency that can stop the kind of abuses we saw at Wells Fargo and at payday lenders and in other markets where there have been significant problems with taking advantage of consumers repeatedly over time. I think that's one of the core reasons you need the consumer agency to have supervisory power and not take it away as the Choice Act would do. So I think having an agency that has supervisory authority, rule writing authority, and enforcement authority across the market is really important to creating a level playing field for consumers and for banks and non-banks alike.
Thank you so much. I yield the balance of my time.
Gentleman yields back. The chair now recognizes the gentleman from Michigan, Mr. Trott.
Thank you, Chairman. Dr. Michel, let's talk about Title II of Dodd-Frank. So some of my friends today have offered a couple arguments as to why OLA is better than a bankruptcy solution. First, they've suggested that the FDIC has got it covered. There's no need to worry about taxpayers being at risk again. And the second argument is that the FDIC will do a better job than a bankruptcy judge at resolving a failed financial institution. So let's look at the first argument. So how has the government done at maintaining insurance programs and ensuring they're solvent in the event of a claim? So for example, how have they done on the National Flood Insurance Program? I think it's $24 billion in the hole. Or how have they done on the Pension Guarantee Corporation? I think it's $79 billion in the hole. Or for that matter, how have they done on FHA? So do you think, based on the government's track record, they're going to do a good job at making sure the FDIC has the money in the event of a failure?
Do I think so?
Yeah.
No.
Well, let's assume that the examples I just gave you. Please continue.
I was going to say I would throw in the FSLIC back from the SNL crisis, and then I would throw in the FDIC from the recent crisis, because without TARP, you have an FDIC bailout. But I'm sorry, go ahead.
Well, I only have 5 minutes.
I'm sorry.
I'm just kidding. So let's assume that all these examples are just an aberration, though, and that the orderly liquidation fund is adequate to cover a failure of the top 6 financial institutions, which would total about $10 trillion. So taxpayers might not be funding that if the money's there, but indirectly, wouldn't consumers still have to pay a price because all the healthy financial institutions have to pay for the failure of their competitors, and ultimately that cost is going to be passed on to consumers in higher fees?
No, that's exactly right. These assessment fees, somebody pays for those, and ultimately customers pay for at least a part of those.
Okay. Well, let's assume that they don't have the money, so they can go under Section 210 and borrow $10 trillion from the Treasury. Would you agree that at that point taxpayers are in the crosshairs again?
Very much so.
Okay. So indirectly or directly, the first argument fails because taxpayers are going to be exposed. Let's look at the second argument. So the FDIC is going to do a better job than a bankruptcy judge. So these are because they have more knowledge and experience. So these are the same folks that were in charge before the last crisis, right?
That is correct.
But now they're all a whole lot smarter. Let's look at transparency. Let's compare the FDIC folks sitting in a closed room versus a bankruptcy judge sitting in an open court. Which is going to be more transparent and lead to a fairer result?
I'd go with the open court.
Okay. Oh, you're answering all the questions right. It's really something. Let's talk about predictability. So you got a bankruptcy judge that has years of precedent, case law, previous decisions. Attorneys, creditors, shareholders can look at that, which is going to lead to a more predictable result. A bankruptcy court that has years of precedent, or the FDIC that every now and then has to deal with a financial institution that fails?
Bankruptcy court, again.
So I spent a lot of time in my previous career in bankruptcy court representing creditors. And by and large, my clients thought it was a fair, predictable, transparent result, but a lot of times they didn't really like the result. Because a lot of times they didn't get any money. Sometimes there was no money in the bankrupt estate for them. They were deemed to be unsecured creditors. Sometimes the money given to them was deemed to be a fraudulent transfer or a preference. But that risk in the bankruptcy proceeding kept the process, kept some integrity in the process. So my question is, don't you think having a bankruptcy process where creditors and shareholders are at risk versus the taxpayers is going to lead to a better decision-making process at the banks and the financial institutions because of the threat of the bankruptcy code giving them zero?
Yeah, I don't see how there can be any doubt, honestly. And I hear the criticism that, well, if we do that, you won't have as many of these repos and you won't have as many of this broad money, as much of this broad money. And I'm kind of flabbergasted because that's exactly the point.
It's kind of like the bond ratings for Fannie and Freddie's mortgages, isn't it?
Yeah.
So thank you, Doctor. Mr. Allison, I really enjoyed your opening statement. I thought your comments and perspective, the real-world perspective, was refreshing, and my only caution is probably too much common sense for us here in Washington, but it was certainly interesting to hear your comments. And I'm going to put up on the screen, if it's here somewhere, I appreciate the staff help me out. That is a puzzle of all the different regulations that affect financial institutions. So I want you just to comment in the 30 seconds I have left what all of those regulations have done to the banking industry, which in turn what that's done to the small business community, which in turn what it's done to what we all care about most here. Democrats and Republicans alike agree on one thing. We all would like to see more jobs created in this country. What has that done to job creation in this country?
It's made banks less efficient. It's made them less able to provide the credit that drives the economy. It's reduced innovation, creativity, and it's made a lot of less good jobs. It's reduced the number of good jobs in America.
Time of the gentleman has expired. The chair wishes to advise all members that votes are pending on the floor. We have 2 members remaining in the queue. Without objection, the remaining 2 members will be accorded 3 minutes apiece. The gentleman from North Carolina, Mr. Budd, is now recognized for 3 minutes.
Thank you, Mr. Chairman. And Dr. Michel, let's talk about price controls, which are put into place on the theory or belief that the market for a good or service just isn't working. So we have a long history of trying to do that in our country.
Indeed.
Yeah. So we look, Nixon tried them in 1971, Carter in 1980. And if you look even recently outside of our country, the Venezuelan food prices controls, they were unsuccessful and are unsuccessful. So Dr. Michel, is the Durbin Amendment, which is a price cap, is it helping the American public, or is it failing like these other attempts?
It's failing like other price controls always do. Somebody finds a way around it. Somebody finds another way to get the money that they lose from the price control, and we see that already. And it ends up not helping the people that supposedly it's going to help. Not that I believe that, but that they really wanted to help the people they say. But
so about those people that we're talking about, the consumers. Yeah. In terms of the effect on their pocketbooks, the Richmond Fed has said that a sizable fraction of merchants raise their prices or debit restrictions as their cost of accepting these debit cards increase. However, few merchants reduce prices or debit restrictions as these costs decrease. So take ideology and history out just for a second. The bottom line, the practical cost of the Durbin Amendment price control is that consumer pocketbooks, these people we're talking about, are you saying they've been hurt in terms of increased banking costs and they haven't seen any other relief in prices? Is that correct?
the evidence ranges from unaffected to harmed. And yes, that's correct.
So these that were supposed to help, these consumers, but it didn't. Why is that?
The idea that we were going to get rid of a regulation for a small group of large retailers, and those retailers were going to just pass that cost directly back, that cost savings back directly to their consumers, is fantasy. And then there would be no other impact with nobody who's lost the revenue trying to pick it up from somewhere else. That's not practical.
Mr. Allison, so from my hometown, you mentioned something about at the end of the day, somebody pays. And could you care to reiterate on that with the microphone?
The Durbin Amendment has been particularly bad for low-income consumers. Banks were providing free checking accounts. And the way they were doing that with debit card fees that merchants were paying. The Durbin Amendment is a huge subsidy for big merchants, for Walmart, at the expense of low-income consumers. Banks are kind of neutral on it because they just cut out free checking, but the low-income consumers have been big losers. Now, the way the banks have been hurt, banks invested billions of dollars to develop the technology to make this system work. You've lost part of the incentive to invest in technology for new things that consumers might benefit because it might be stolen by legislation. Price controls never work.
Thank you. In my remaining time, one quick question. So have the prices for merchants that do a lot of small ticket items, have those risen as a result?
The time of the gentleman has expired. The chair
Thank
now
you. I yield back.
recognizes the gentleman from West Virginia, Mr. Mooney, for 3 minutes.
Thank you, Mr. Chairman. Recently, proponents of the Dodd-Frank Act have rolled out numerous anecdotes and favorable data to prove that with Dodd-Frank in place, the economy is growing, banks are both profitable and lending. But what you don't hear about is the overall regulatory costs imposed by Dodd-Frank that are weighing down our economy. A current analysis by the American Action Forum found that compliance with the Dodd-Frank Act has cost $36 billion and 73 million hours of paperwork, the equivalent of almost 37,000 employees working full-time on paperwork for 1 year. As I travel my district in West Virginia with small community banks in small towns, the pain that I hear from folks that work at banks that they have to hire full-time employees just to do paperwork and pay them salaries, money that could otherwise have been lent to buy a home or start the American dream of owning your own business is evident. So Dr. Michel, has Dodd-Frank helped, quote, lift the economy, close quotes, since it was enacted in 2010?
No, and I wouldn't have believed that to begin with. We've done some analysis. We've done, as far as I can tell, one of the first real macroeconomic modeling analyses of this very question, and we do show that you've had a significant impact of, I think I mentioned before, of about 1% per year in GDP. That would be the loss associated with the increased cost. That would be the gain from removing it. You've got a significant increase to the capital, a decrease, I'm sorry, to the capital stock in the nation, and there's a dynamic effect on that in terms of the revenue effect that we have on the budget and just in the economy in general.
Thank you. And a quick follow-up. What have been the macroeconomic impacts of the hundreds of new regulations imposed by the Dodd-Frank Act?
So, unfortunately, the part that we did was very narrow. Well, I shouldn't say unfortunately, but I should say that the part that we looked at was a very narrow look. So I would imagine it's much worse. I don't have the macro analysis because I can't. It's almost intractable, the problem. We're talking about over 400 rules. We're talking about rules that span the entire financial spectrum. Macroeconomic models can't really handle a lot of that stuff very easily. So you have to start doing a lot of subjective manipulation, I'll call it. And we didn't want to get into that. So I suspect that it's pretty severe. And I would add that a lot of the stuff where everybody talks about how we've had the worst recession since the Great Depression. Well, yeah, and a lot of that actually happened after we started doing all this stuff. So, that doesn't get a pass.
Thank you. Thank you all for your testimony today. Mr. Chairman, I yield back.
Gentleman yields back. I want to thank our witnesses for their testimony today. Without objection, all members will have 5 legislative days within which to submit additional written questions for the witnesses to the chair, which will be forwarded to the witnesses for their response. I ask our witnesses to please respond as promptly as they are able. This hearing stands adjourned.